Hello viewers, welcome to our channel. Today we are going to kickstart our new course, and this is going to be Dcf Valuation Modeling. It's a Dcf Valuation Modeling course that we are going to kickstart today. So what we want to look at for now is for us to learn more about the Dcf modeling, and we can be able to see what we can have. So without wasting more time, let's dive in and look at the course overview. In other words, we are going to look at the summary of the course, all the things that we may look at. In other words, we are going to pick out those key things that make up the Dcf modeling. Our Dcf modeling, the Dcf, actually the D stands for discounted, the D stands for discounted, then the C stands for cash flows. So it is discounted cash flow valuation modeling. It's the course that we are going to look at. So Dcf valuation is one of the most common valuation techniques used in modern finance today. This technique is flexible in that it can be used for very early stage growth companies as well as established companies operating in a more mature industries. Although the Dcf valuation is one of the soundest valuation techniques, errors in Dcf models are actually quite common. Finance professionals often make mistakes related to the calculation and pairing of the company's cash flows and its discount rate. Finally, many financial professionals struggle with the right level of details for income tax calculations, and so they fail to correctly break out the current and the deferred taxes in both leveled and unlevered income tax schedules. So this Dcf, as you are seeing, is something that we probably want to look at. This Dcf valuation modeling is something that we basically look at in terms of looking at the discount rate and at the same time looking at the cash flows. So the cash flow profiles and the discount rates, they always give challenges to financial professionals. And when those errors or challenges happen, it makes these things to be a little bit tricky. So you find it is problematic for financial professionals to actually get the right cash flows and the discount rates. And at the same time, you find some of them, they struggle in terms of the detailed calculations for income taxes for both the levered and unlevered income tax schedules, as we shall look at. So there is one key concept that we need to focus as far as discounted cash flow valuation modeling is concerned, and that's what we call the time value of money. The time value of money is something that we always use as far as Dcf is concerned. But in our course, we prefer to call it, instead of calling it time value of money, we prefer to call it time quantity of money. So we prefer to call it time quantity of money. And we shall look at the reason as why we prefer to have that in that scenario. So we shall look at these things when we reach there, but we prefer to actually call them time, to look at it in terms of time quantity of money. Because what you have to understand from this perspective is that the movement of cash flows, the movement either backward or forward movement, is usually referred to as the time value of money. The movement of those cash flows, we always look at them as the time value of money, those movements. But now, as we've said, we prefer to call it time quantity of money because it's the quantity that is going to be changing. So we are not going to basically have anything or the value that is going to be changing, the value of the money. But we are only looking at it in terms of the quantity, because we believe it is only the quantity that is going to be changing. For example, for the backward movement, as we shall look at these computations in details, but you will be seeing something called discounting and compounding of different cash flows. But since we are looking at the discounted cash flow techniques, it means we are discounting these cash flows back from the time period to a given time period. And we are using the discounting rate to actually have that in place. So the things that we need to look at here is that we need to understand the objectives of someone going through the whole course of DCF valuation course. The DCF valuation modeling course will allow you to get exposed to the following things as long as you complete it with all the tutorials that we are submitting. So upon completing this course, you will be able to understand. Let's maybe look at some of the objectives. So the objectives, they're actually very many, as summarized in that sheet that we've displayed there. But what you have to understand from this point is that upon completion of this course, if you be with us until we actually finalize all the things that we are supposed to talk about, you'll understand how DCF valuation compares to comparable trading analysis and precedent transaction analysis. And then you will also be able to have the knowledge of knowing the pros and cons of each of the valuation techniques, because the DCF valuation technique and these other two, the comparable trading analysis and the precedent transaction analysis, those are the things that we use when we are actually trying to do the business valuation. So when you complete the DCF valuation course, you'll be able to compare the DCF valuation techniques with other valuation techniques, and you'll be able to see the advantages and the disadvantages of using any of those two valuation techniques against the DCF valuation. Because remember, we said this is one of the most commonly used valuation techniques of recent. The other item is you'll be able to review the importance of upfront model design and the best layout for DCF models. So you will be able to understand the importance of having an upfront model design and the layout of the DCF model, because we shall see this when we have optimized this model for presentation or for printing. Still, you will be able to discuss the common errors made with income taxes and the need for both a leveraged and unlevered income tax schedule in the model. We need to have an understanding of the income taxes, because we need to understand the current and the deferred taxes and their implication towards our model building. So you'll find you'll be able to understand the common errors that are done when computing the income tax values, especially the current and the deferred tax, and how we'll be able to treat those in our financial models. The fourth objective is that you'll be able to understand the importance of pairing the right cash flows with the correct discount rate. The right cash flows, of course, those are the cash flows that we shall see as we move ahead. Even the discount rate or the work, we shall be able to have an understanding of pairing the right, supposed to be the actual word there is the right values to use, because there is when you use the wrong cash flows and you pair them with a wrong discount rate, and you'll also be able to see the implication for that. And at the same time, we'll be able to review the steps for calculating each of those values in details, calculating the right cash flows and also calculating the right discount rates to use. The other objective is we shall be able to build separate schedules for both perpetuity methods and the multiple methods for calculating the terminal value, and discuss the common errors related to timing. Remember, for those who may be having some theoretical bit of financial management, you will also understand that it is actually very important for you to know when you're supposed to receive the cash flows, leave alone knowing the right cash flows. But at the same time, you need also to be knowing the right timing, or the timing of those cash flows. Are they coming at the beginning of the period? Are they coming at the end of the period? Or they are coming in between the period? A period can be a year, can be a month, it can be a quarter, whichever it is, as long as the cash flows are coming in that specified period of time. So you'll be able to understand even the timing is also very important. Lastly, we shall be able to understand design, and we shall be able to understand, after completing this course, we shall be able to understand how to design and build a dashboard for stakeholders using data tables. Remember, everything is going to be done in Excel. We will be able to use data tables. So for those who actually don't understand how to use them, it's be the right time for you to actually get to this point. So it's better you make sure that you follow through until we finalize these values, because it is very important. These data tables, the data tables are actually very important. So that's basically what we can talk about as far as looking at the overview of this DCF valuation modeling course. Remember, this DCF valuation modeling course is one of the courses that actually form the financial modeling, that's FMVA, because it is very key for the FMVA course to actually include in the discounted cash flow techniques, because the DCF valuation modeling course, it is one of the core courses that are supposed to be attempted if you are to actually become very good at financial modeling and then valuation. So that's what we are going to look at. So without wasting more time, let's go to the next video and try to look at we start off the course. We look at the outlines, the things that we are going to talk about, and we shall start from there. Thank you for watching. Let's meet in the next video. Hello viewers, welcome back. We are now looking at You're now looking at the Dcf valuation modeling, and this is the course that we are starting. We said in the first video that this is one of the methods that are recently used by most of those within the finance profession today. What we are going to look at chapter by chapter in this, we are going to look at the Dcf model theory, and we are also going to have different videos in that Dcf model theory. We are going to look at the theoretical aspects, the small theoretical things that we can have, but they are not all that 100% theoretical. So we shall look at that as our chapter number 1, and then we look at the other chapters as we progress. So we are going to be having different videos in these chapters. So the second chapter will be about the compact DCF model, and there we shall be starting the practical bit of that course. So those are the things that we are going to basically focus on as far as the course is concerned. So we shall look at some of those things, and we shall see how we can be able to adjust as we move forward in the course. So the first chapter, we said it is DCF model theory, and we are going to look at the course introduction. So that's what we are going to look at in brief. My name is CPA Charles Cafe, and I'm a certified financial modeling and valuation analyst. So welcome to our YouTube channel, where we are engaging into different aspects as well as finance and accounting are concerned. So we are going to talk about the DCF valuation modeling. That's our course for today. DCF modeling is one of the most common and sound techniques, and what we are going to look at is how we can develop a DCF model. We will forecast the company's cash flows forward in the process called compounding, and we will also discount them back to their present worth. In other words, we shall discount them back to their present value, but we are going to be so careful to avoid some of the most common mistakes that people get into. But all the time we go through these tutorials, we will be building the highest possible standards of the industry. In other words, what we are focusing on by building the DCF model, we want to build it in a sense that it is going to be of a more professional and standard. In other words, it's supposed to be up to the standards of the industry. So in order to benchmark to the industrial standards, we will be referring to some of the model guidelines. Those model guidelines, we have a PDF, and it is within our Telegram channel. So we encourage you guys to join, be part of that Telegram channel, subscribe to the channel, so that you can actually be able to receive some of these information, some of the notifications as and when we've uploaded certain things, because those are actually mainly, they are not focusing on one course, they are focusing on things that you need as a finance and accounting profession. In other words, our area of focus is whatever that we can within the accounting and finance docket we shall deliver to you. So that's our main focus, as well as the things that we try to accomplish. So that financial modeling document is the one, you can download it, it's free. You can download it because it will be the one that will help you to understand the best standards for financial modeling. So as I said, You can access that document from our Telegram channel. The link is within our YouTube channel in the About To section. So you can check it, join and be part of it so that you can be able to download some of the downloadable documents that we have in there so that you can be able to follow along within this when you are going through these practical aspects. So that's the end of the first video within our first chapter of DCF model theory. So we'll see you in the next video where we are going to look at the important dates. What are the dates that we need to look at when we are doing our modeling? So let's see you in the next video as we are talking about the important dates that we need to have in place. Hello viewers, welcome back. Welcome back to our Dcf Valuation modeling course. We are so excited to be sharing this course materials with you. As you can see from our first video, we've directed you where to go so that you can be able to download the course materials. They are within our Telegram channel where you can find the template that we are going to use from these tutorials, but as per now we haven't uploaded it there. So maybe we finish this, when we finish this chapter we shall upload that there and we shall be able to see some of those things from that point. So what we are going to look at now, we are now going to move into the model building. We are going to move into the model building and we are going to look at the processes that we supposed to go through as far as we finalize some of these things that we have in place. So it is very important for everyone working in finance to understand how to build a DCF model the right way. And in fact, we are going to start with the compact discounted cash flow model or the DCF model. So that's what we are going to start with. It is really important to know how to construct one of these compact or simple DCF models quickly for a couple of reasons. First of all, one of these simple or compact DCF models can really help us learn the main features of the DCF model without getting distracted with some of the complexities within the other full DCF model, because we know that these simple DCF models, they actually help us to get the picture of what we may be looking at. But now, the other full model, actually you find it has so many things that are going to be new to some of you guys, and you may find yourself a little bit confused. So when we start from the simple DCF models, they will actually give you the picture of how the end result will look like. So the other place where these compact DCF can really be helpful is that they can really help in situations that require some quick analysis. A quick analysis in terms of someone wants maybe to do some ratio analysis, someone wants to use maybe a common sized income statement to try out and do some analysis. So these simple DCFs will actually help us. But don't worry, because in this course we are also going to build a full DCF model. And that full DCF model, it is going to have a lot of complexities. But for now, let's dive in and take a look at what we need to know in order to build this compact model, because we need to know the things that are within the model itself. So let's now try to move ahead and think about what DCF models are and how they work. It's fair to say that we use DCF models in order to value businesses. In fact, the business value itself depends on the quantity and the timing of the expected future cash flows. In other words, the value of any business is within the future cash flows they anticipate to receive, taking consideration the timing of those cash flows. In fact, we can really think about a business as something which generates a number of future cash flows. And once we take all of these cash flows, the future cash flows, and we discount them back in time to arrive at a present value. In other words, since we anticipate that we are starting the business to make profit, and those profits are going to come in the future. So the thing is, we are trying to focus a little bit more on the cash flows that we will receive in the future. But at the same time, we need to look at the timing. In other words, since they are going to come in the future, we need to discount them back to know what is their present worth. And the reason as why we are doing it is because we are valuing the business today. But the business itself, it only anticipates to receive some cash flows. Remember, these cash flows, they may be outflows or inflows. In other words, the business is spending and it is also earning. So if they are expecting inflows to come in, so what we need to do is to make sure that we discount those cash flows back to their present, so that we can use their present value to get the value of the business. Because the value of any business is the present value of its future cash flows. And that's how we do business valuation as far as DCF techniques are concerned. So now, remember, we've said that these cash flows are going to be coming in a given period of time. You may say that we anticipated that in year one, we are going to get 10 million US dollars. In year two, we might get maybe $15. In year three, we may get maybe $25, depending on our projections that we did. But now, since those monies are coming in at a different intervals, they are coming in a different timing. What we need to do after getting the present value of their respective timings, we make sure that we add all those discounted cash flows and we effectively get the value of the business. Remember, if in year one you are receiving 10 million, the question is, what is, if I'm valuing the business today, let's assume today is year zero, how much will that be? If someone says, I'm going to give you 10 million today, and the other person gives you maybe 12 million at the end of this year, so the person is going to be asking, how much can the 12 million that I'm receiving in the future be now? The only way to get that value is by discounting. So if someone is receiving that money in 2 years' time, the issue is, how much is it now? The getting that now value is what we call the present value. So, and that present value is gotten by discounting those cash flows. So after discounting those cash flows, we sum them up, and the value is going to be the total value for the business. So what we are really doing is we are converting all the future cash flows to their present value, and their present value is what we call the present worth. In other words, the equivalent value of those future cash flows today, that's what we call the present value. And that gives us the value of the business. Now, let's think about something else. Let's think about some really important dates, especially when we are building DCF models. There are some dates which are very important, because we've been talking about receiving money in 1 year, receiving money in second year, receiving money in third year. So the point is, which dates are those that are important to us, especially when we are doing DCF models? So, in fact, there are two critical dates that we always have to consider in these models. As long as you are using DCF technique to value the business, there are two important dates that you need to actually take into consideration. One, we need to understand the timing of these cash flows. So, the cash flow timing is really very important. The timing of these cash flows is really important. And the second one, we have also to look at the valuation date, the date when we are doing the valuation. In other words, the date that we are carrying out the valuation. Those two dates, they are actually very important. So, if we first think about the future cash flows, if we try to think about the future cash flows, and these future cash flows, they're actually the amounts that we anticipate to receive in the future. In other words, if you look at this point here, this first one, the first concern, this one as our first concern, if you look at this area here as our first area of concern, the point here is that we need to make sure, the point from this perspective, we need to make sure that we need to make sure that we know the dates within each year when these cash flows occur. So what do we mean by knowing the dates at which these cash flows are going to occur? Knowing the dates at which these cash flows are going to occur, it means we need to understand whether these cash flows are occurring at the beginning of the year, whether they are at the beginning of the year, or they are in the mid of the year. Are we receiving these cash flows in the mid of the year, or are we receiving them perhaps at the end of the year? Are they at the end of the year? That's very, 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 very important. And the reason that's why these are very important is because we need to know so that we can plan well. Because you may be suggesting that I'm going to buy maybe a certain machine in year 1, but you find when these cash flows are actually starting to come in year 3. So which one are you going to be using to purchase some of those machines that you are suggesting? So now, for the purposes of simplified compact model, we are going to assume that these cash flows are occurring at the end of each year. This is what I want us to actually put in focus. For now, for these simple methods as we are talking about them, we are going to assume that these cash flows are actually coming in at the end of the year. That's what we are going to assume for now, that we are receiving these cash flows at the end of the year. Now, when we look at the full DCF, we are going to talk about how to control the model when these cash flows occur at different times. Like, for example, in the mid of the year, or maybe they are coming after maybe year quarter 1. In other words, because there are those projects, let's say for government project, you are constructing maybe a certain building or a certain warehouse, and they are telling you, for us, we are going to pay you money at the start. We give you some portion at the start. We may give you the sum portion at the end of the year, and maybe in between there, provisionally, if it is actually necessary. There are those that are projects that you are going to have, and they will take maybe long time for them to be giving you the inflows. Maybe for government, they have taken long to pay. So we need to understand, but for this simple, because we are going to look at a simple DCF. This simple DCF, we want to assume that these cash flows are actually coming in at the end of the month. In other words, we don't need to worry about the timing. But when we look at the full modeling course, or the full DCF full model, we want to look at those three assumptions: when the cash flows are coming in at the end of the period, at the beginning of the period, or in the mid of the period. So now let's think about these two ideas in that format. So that's what we are going to assume as for now. So the other thing now we need to look at is this item here, the valuation date. We are done with this. We are now done with the timing of the cash flows. We've said for now we are going to assume that they are coming in at the end of the period. But for now, let's try to look at the valuation, this valuation date. Now, this is the date that we set, and we use it for the valuation. In other words, this date is going to actually be set. We just set it, and we only use it for valuation. So we are going to just use it for valuation, but it's us who set it, because you may decide that I'm going to start the valuation in maybe after 5 years, or maybe I'm going to start now, but I will proceed up to maybe 5 years from now, or I push it 5 years backwards. So it depends, because these financial models, they are going to be done by experts. First of all, you need to have the information before you actually come to start doing some of these analysis. So we always set the date, because we are the ones preparing the model. So it is the date that we are going to set for our valuation. So when we refer to a present value, that present value is as of the valuation date. In other words, if we say that we are going to start valuing in this year 2024, the point here is that we need to make sure that at least the present value for us, we are only looking at it as 2024. If you are projecting, if you are forecasting a project of 5 years with a lifespan of 10 years, 5 years, you look at 2024 as your year of forecast. In other words, the valuation date. So effectively, all the cash flow quantities are going to be adjusted or discounted back to this valuation date. In other words, if you say that in 2024, that's our valuation date, maybe let's say June 1st, then this June 1st is going to be our valuation date, meaning all the cash flows we anticipate, we shall start forecasting the cash flows of 2025. We go to 2026, 2027, up to maybe 2030. So all these cash flows, they will be discounted back to 2024. Here is going to be discounting. But when you are projecting from 2024 to 2025, what we are doing there is what we call compounding. In other words, we are forecasting in the future. But this discounting is coming from the future to the present, meaning this will be our present value. All the present values will be in that year 2024. So that's what we are discussing here, that all our future cash flows will be discounted back to their present value, and the present value will be that date of valuation. So, hope we've been able to understand some of the key things that we've looked at. But now, what we are going to look at in the next video, we are going to dive in and take a look at the mathematics behind that explanation we've been talking about. And we see exactly how that works. So that computation that we are going to look at is what we call the time quantity of money, or the time value of money. So the next video that we are going to look at is going to be looking at the time value of money. So those are the things that we are going to look at from that perspective. So let's see you in the next video as we are looking at the time quantity of money. Hello viewers, welcome back. We are now looking at the time quantity of money. So we are now looking at the time quantity of money. That's what we are focusing on for now. Time quantity of money. Now, some of you guys may be surprised that this course is titled the time value of money, as you can see up here. In fact, the process of moving cash flows, forward or backward is usually referred to as time value of money. It's usually referred to as time value of money. Now, here we prefer to use time quantity of money because it is really the quantity. It is really the quantity of money that is changing over time. The value of money can also change over time, and the change comes about because of the inflation rate. It is the inflation rate that brings about the change of money over time, because inflation essentially erodes the value of money over time. But for now, in this discussion, we are going to focus on the quantity. We are going to focus on the quantity and how that quantity can change over time. So I want you to get me right. I don't want you to assume that we are ignoring time value of money. Yes, we know the value of the money changes over time because of the inflation. Because the inflation erodes, or it takes away the value of money over time. As it grows, you find that something that was costing 1 million today, US dollars, in 2 years' time, when the inflation is high, it may not cost the same. You may find it is going to be costing 10 million. So that's what we call inflation, meaning the value, the item that was being purchased at 1 million US dollars is now being purchased at 10 million US dollars. It means the value has changed over time because of the inflation. But here what we are focusing on is actually the quantity, that we've moved from 1 million to 10 million. We are talking about the quantity because it is actually the quantity that is changing. So that's why we are focusing our discussion on the quantity. Now, let's bring into this small diagram. Let's first have this off. We try to have that diagram into focus. I want us to look at this diagram right here. This diagram right here. So this simple example that we have for now, the first thing that you can notice is that there are some numbers that are in blue. This one is in blue, this one is in blue, and these ones are also in blue. So those are in blue font. In other words, the font color is blue. And we've said from our previous courses that our blue font is typically used in financial modeling to portray an input. In other words, those are inputs, whichever that is in that blue, whichever is in that blue is looked at as input. Now, so here we have our input. The first input as for that year one, this is the year. Year one is 40,000 US dollars. So the 40,000 US dollars, we are seeing this one has these years, and here we are looking at the forward movement. The forward movement of these cash flows, year one, year two, year three, year four, year five. We have the growth rate. The growth rate, you can take it as the inflation rate. In other words, the rate at which inflation is growing. Then we are also trying to project the future cash flows here. So the question is, today in year one, we have 40,000 US dollars as the money we are putting in the project. Or it is the money that we have, 40,000 US dollars. The question is, if you are to project these values, if you are to move from this point and you are growing it by 10%, then it will give you this value here. If you move and you grow it by 10%, like that, you grow that figure by 10%. So we have, you can see that we have a 10% year over year. This one we have a 10% in year 2, year 3, and year 5, 4 and 5 as our gross rate. And that gross rate is for this amount of 40,000 US dollars. Now, what we can see right here in these black numbers, because these black numbers here, those black numbers, those that are within the black font, we always say those portray the formulas. In other words, those numbers are formula driven, and that is the company's cash flow quantity for that year two. In other words, we can see that from this blue one, we are now increasing from the $40,000 to that value, as you are seeing, 44,000 US dollars. And the quantity is increasing over time. For instance, the 10% growth in year two, you can see it has increased the cash flow from 40,000 to 44,000. And there is another 10% increase in year three that increased the value from 44,000 to 48,400 in year three. Meaning this 48,400 has increased by 10% to 53,240 until you reach to the last value here in year 5. But now, so if we try to look at this, if we try to look at here, the growing here, or if we try to move forward, we are always moving forward into the future. So we always grow by what we call compounding. And the value for compounding, or the formula we use, is that future cash flow will be equaling to our present value that we have for now. We multiply, then we open bracket, 1 plus R. In other words, this is how we compute the increase. If someone says something is increasing by 10%, the actual computation is that it will be 100 plus the 10%, and that will give you 110%. So if you want to find out that this 40,000 has increased by 10%, it is just a matter of saying 1.1 times the 40,000, and this will give you 44,000 US dollars. And the other person could first take the 10% of the 40,000 of this 40,000, and that will give you $4,000. Then it will be the 40,000 plus now the $4,000, and that will give you $44,000. So whichever way you go, it will actually bring you to the same thing. But if you look at the formula that we have here, the one for future value, this is the formula that we use for financial management for computing the future value in the process of compounding. So what we do, we get the future value. For us to be able to get the future value, it will be 40,000, which is our present value. The value that we have today is this. So we multiply that, open bracket, 1 plus, what is the growth rate? This R is our growth rate. So which is 10%. 10% is 0.1. So add 0.1 there. It will be 1.1 multiplied by 40,000. And that will give you 44. That will give you 44,000. And that's exactly what you are seeing in this. See? That's exactly what you are seeing in this small box here. That's how we got in the. So that's what we are seeing from this box that we are having here. This box right here is trying to compute that. So that the operation will actually continue up to year 5. And the value we shall get for year 5, it will be 58,564 US dollars. And that's how we've been able to compute the forward movement. That's the first way that we actually compute the amount that we shall be having in the future. And we refer to that repetition as compounding. So we compounded from the original $40,000 over and over through these years to get to the total of 58,564 by year 5. So now, hope you've been able to see how we've done the mathematics and how it works. We've taken the $40,000, we multiplied by 1 plus 10%, and that gave us $44,000. So the real takeaway from this point is that the same process that we used to compute the first cash flow here of 44,000 is the same process that we continue over and over through until we go to the different years that we have to forecast. And that's what gave us that value that we call the compounded amount of 58,564,000 in year 5, this value right here. So that's how we've been able to move in that same format. Now, it's really simple and very intuitive to move these quantities of cash flows forward into the future as they grow. That's how we forecast. We forecast by growing the first cash flow we have as our input. For example, the 40,000, and we move forward into the future for these different years up to year 5. So that's how we've been able to compute some of those things. Now, what now we are going to do, we are going to take a look at the backward movement, because in finance, it is actually more common to move in the reverse order. That's what we call the backward movement. In other words, we take a quantity of cash flow in the future and we move it backward in time. In other words, it's going to be moving backwards in time, and we refer to that process as discounting. That's what we are going to look at. That's what we are going to focus on. Because always in finance, we make sure that at least we have that backward movement. We always have that backward movement in those cash flows. So let's take a look at how discounting works. Let's bring up this diagram. This diagram looks very similar with what we had previously, but we can see that there is only one key difference that we have. The key difference is this point here. The key difference is right on this, is right here on our right hand side, where we are starting from the highest value. Remember, this is the highest value that we had. So this is a backward movement. The other one was a forward movement. So we are now moving this value that we got earlier, as we are using it as our input. That's why you are seeing that this number in year 5, the number of 58,564 US dollars is actually the number that we have in year 5, and it is in the blue font. And we said blue fonts portray inputs. So we are starting from this year 5 with this value of 58,564 US dollars as our input. And we are starting from this point, and we are moving in a reverse format. In other words, we are moving backwards like this. We are moving backwards. So what we can do from this point in year 5, from this point here of year 5, is now we want to reverse the process backward. And we are going to reverse the process backwards in this format. In other words, this is our starting point, year 5. We are trying to move in this format. We are trying to move in this way, to this side. That's how we are trying to move. So we are moving backwards from the year 5 up to the year 1. And that process is what we call discounting. This process here is what we call discounting. So as you've seen, the way the mathematics would work for this is that we take the amount, this amount, 58,564 in year 5. And what we are going to do, we are going to divide that value. We are going to divide that value by 1 plus. Divide that value over 1 plus the growth rate. The growth rate was 10%, which is 0.1. And that will give us 53,240 US dollars. And this value is exactly what you are seeing from this point here in year 4. So, and that's the same thing that you are seeing from this same bracket here. We are trying to move backwards, and we are using the present value formula. In other words, we are moving backwards using the present value formula. Is future value over 1 plus r. Remember, it is always to power n. But here we are moving only 1 year. So even if you just get this of power 1, it will still give you the same answer. That's why I'm not putting in these numbers. Even the other side, I didn't put the number of years, because this n here represent the number of years. So if we continue this process backwards by 1 year, meaning since these years are not going to change, we are always going to be dividing by 1 plus 10%. So what are we going to do? We are going to make sure that at least we are dividing backwards by 1 year. In other words, we move 1 year, 1 year, 1 year until we finalize everything. Because these cash flows are also coming in year by year. So we can also see from this note right here is that the operation can continue backward to year 1 to get this value of 40,000. But now to this one, you will find that these values are actually bringing us to the value that we started with of $40,000. And we call that process discounting. So it is a discounting process. In fact, that's where you get that D. Because remember, we have the course is DCF. And this D you are seeing here, the D within the DCF model is actually this discounted cash flow. That D within there is the one that is talking about discounting the cash flows. You are taking the cash flows and you are discounting their quantities back in time to their present worth. In other words, the meaning, what the whole thing here means is that this value that I'm supposed to get in 5 years' time of 58,564, if I'm to get this money in 5 years, it will be that. But if I want this money to be given to me now, they will only give me 40,000 US dollars. So if I'm to wait, I'll make sure that I have this difference. If you less off this from this, you'll be getting the 18,564. And that difference is what is lost with time. So that's the implication from that perspective. So now, to do a DCF technique properly, we need to make sure that we have the right cash flows. So for us to do a DCF correctly, we need to have the right cash flows. Because if you don't have the right cash flows, you will not make the right computations, because all these computations are actually basing on the cash flows that we have. So if you don't have the right cash flows and the right discount rate, if you don't have the right cash flows and the right discount rate, then the cash flows, then it means you will not be able to have a proper DCF computation. So we need to have the right cash flows and at the same time the correct discount rate. And these two are the two areas where people often make mistakes. So in the next video, we are going to dive into those cash flows and discount rates and figure out exactly which cash flows to use and which appropriate discount rate that we can also use to make sure that we have the right DCF model. So we see you in the next video as we are talking about cash flows and the discount rates. Thank you for watching. Hello viewers, welcome back. We are now looking at cash flows and discounting. We are looking at cash flows and discount rates. Changing cash flows and choosing cash flows and choosing the discount rates. Remember, we've said in our previous video that having a proper model is supposed to make sure we are supposed to make sure that we choose the right cash flows and the right discount rates. So the discount rates and the cash flows, they are really very important for us to make sure that we have some of those things done correctly. Now, so having understood what we are going to look at, choosing the right cash flows and a correct discount rates can also be tricky. In fact, in DCF models, that is a very common place for people to make errors. Essentially, they get the wrong cash flows and incorrect discount rates. So the question becomes, which cash flows and which discount rates are in fact correct? So if we try to bring in this little diagram that you are seeing here on our screen, we can see that we have the cash flows up here on top. And we are wondering about which discount rate to use to bring those cash flows back in time at the bottom here. So the question is, are we going to make sure that we discount these cash flows using the right values? Well, a person who studied financial management or has done some financial theory might be able to tell us that we should be using the unlevered free cash flows. Those unlevered free cash flows, those are the ones that we shorten it to be UFCF, and we shall discount those cash flows back at the weighted average cost of capital. That's what we call the WACC, the weighted average cost of capital, as you have seen in this diagram here. Now, we have these shortcuts, or the acronyms that we, for these two terms that we use. We say the UFCF and the WACC, that is WACC, for weighted average cost of capital. And the UFCF is unlevered free cash flow. So we might also know that these are the correct, they are in fact, they are the correct pair to have so that we can have a good DCF model. So we pair up the unlevered free cash flows with the weighted average cost of capital. So we pair this one and this one. So, but memorizing this, like memorizing these formulas, as you can see, is something else. But what we want to do, we want to get to the bottom of this. We want to understand why we use the unlevered free cash flow and the WACC. So if you try to look at this formula again, or this little diagram that we have here, you are seeing that the values that we have there, we have the values that are unlevered free cash flows over the WACC. So let's take a look at this diagram right here, this one right here. One theme which come up time and time again when we are doing valuation work is, it is a theme of consistency. It becomes as a song. Whenever we are doing valuation, we have to have consistency in place. If we are looking at comparable trading analysis, or precedent transaction analysis, which are also two very common valuation techniques. Consistency is going to come up time and time again. In other words, consistency will always be there. So for this discussion of DCF modeling, the consistency that we need is between the numerator and the denominator consistency. It is within what we are taking as our cash flows and what we are dividing as our discount rate. So again, if we try to bring in this diagram into focus, if you try to bring that diagram into focus, the numerator and denominator consistency. The numerator, as you can see, the numerator and the denominator, to refresh our mind or to refresh our memory, we have the unlevered free cash flows on top here. The unlevered free cash flows on top. And we also have the weighted average cost of capital at the bottom as our denominator, this one here. Now, let's take a look at these two items, the numerator and the denominator. The numerator is actually the cash flows. In other words, the unlevered free cash flows. The unlevered free cash flows. Those are actually cash flows that are available to all capital providers. In other words, it's the money that is available to all capital providers, including the debt providers and at the same time the equity providers. And what we have at the bottom here is we have the weighted average cost of capital, or the cost of capital of all capital providers. In other words, the work that we have is computed after taking into consideration of all the capital providers. In other words, whatever we have on the bottom and what we have at the top, there is some consistency there because they are all representing all the capital providers. So the key is this consistency of all capital providers being represented on the top in the numerator and on the bottom in the denominator. So we really have here, so what we have here is perfectly consistency between the numerator and the denominator, with both representing all capital providers, meaning all the capital providers, including those of debt and equity. Meaning we have those that brought in debt, like the financial institutions, and at the same time we have those shareholders who brought in their equity. So when we are discounting the unlevered free cash flows, we use the weighted average cost of capital. And that gives us what we call the enterprise value. It gives us what we call the enterprise value. So that's what you are seeing as we've brought this side here in the right hand side. That's what we have there, enterprise value. In other words, the value of the business. So now we understand how to pair up these cash flows with the correct discount rates in order to get the enterprise value. But if we are going to model out cash flows, one of the things that we need to contemplate is exactly how long are we going to forecast. In other words, how long are we going to forecast for in our model? So what we are going to look at in the next video, we are going to dive in and look at the how long should we forecast. So by the end of that video, we shall be able to understand how best we can forecast for our model. So let's dive in the next video and we'll talk about that. We'll see you soon. Hello viewers, welcome back. We are now looking at how long to forecast for in a Dcf model. And that's what we are going to look at for now. So what we are looking at for now is how long to forecast for in a Dcf model. And it's a common Dcf modeling question. So what we want to discuss here is a very common Dcf modeling question. In fact, you may encounter this exact question as a technical component in a financial interview. Exactly how long do you need to forecast for in a Dcf model? Really common for people to come and say, well, you would probably need to build a model that extends for, let's say, 5 years, or maybe for 10 years, 20 years, and so on. One fact is that the correct answer to this question, how long do we forecast, is that you need to forecast forever. You need to forecast forever. So we forecast forever. So let's take a look at why we should forecast forever. In other words, it is in that format because we want to make sure that we understand what we are talking about. So we want to make sure that we understand what we are discussing, and then we are going to talk about exactly how we are going to accomplish that. Because what do you mean by saying you forecast forever? Because forever has no limit. It is at infinity. So how are we going to accomplish that, if that's basically the task that we have to do? Now, often when we are doing valuation work, we start with the assumption that the business is a going concern. We assume that the business is a going concern. Let's think about what a going concern means. This is an accounting term, and it essentially means that if you assume that the business is a going concern, then you are assuming that it's going to continue to operate indefinitely. In other words, it will not stop operating indefinitely. It's going to operate indefinitely. So what we are essentially assuming here is that the company is going to last forever. It means that we need to forecast the cash flows forever into the future. So because now someone is going to be wondering, how exactly are we going to be doing this? Because after all, if you look at Excel, the software, the Microsoft Excel as a software itself, and you move all the way to the right hand side within your worksheet. So you find that spreadsheet, if you find that that spreadsheet, you would see that it actually only has a fixed number of columns, and they're about 16,000. The columns, those that are moving downwards, A, B, C, up until you reach the last one. Meaning within our Excel, since we are, remember we are forecasting in Excel, but Excel has a limit of about 16,000 columns. Now the question is, how are we going to be able to forecast forever yet Excel is having a limit? So the solution is, so the way we are going to forecast forever is if we are working inside a spreadsheet that has a fixed width, then the trick that we are going to use is that we are going to make sure that the key to forecasting forever is really understanding that there is two parts to a typical DCF forecast. In other words, for you to be able to forecast forever, you need to make sure that you understand that this DCF forecast should actually have two typical forecasts. Now, those two parts, they are going to separate our cash flows into two. So the first part we are going to call it our discrete forecasts. And the second part is going to be a terminal value forecast. In other words, for it, it's not even a forecast, it's going to be a terminal value, because we just get only one value to represent the entire forever assumption. So part one is going to have, the discrete. So part one is going to have the discrete forecast, and then part two is going to be having the terminal value. So the two parts to a typical DCF forecast, those two parts to a typical DCF forecast. One, we've said it is a discrete forecast, and second, we've said it's a terminal value. Now, let's start by looking at this part one. Let's focus on this part one here, what we call the discrete forecast, and how we can define it. So this part of the forecast shows the first few years when the company is growing faster than the economy. In other words, we define these discrete forecasts as the type of forecasts that shows the first few years when the company is growing faster than the economy. And what happens over time is that the growth for the company may slow in later years. So the first thing is that the few years when the company grows faster than the economy. Then the other key idea to note is that over time, the growth of the company slows down in those preceding years. And that may be as a result of maybe competition, maybe there are so many people who have entered in the market and now they have taken away the market share. So as a result of competitors that have entered the market, eventually the company reaches a steady state. So When the company reaches a steady state, in other words, it reaches its climax, the stable state. And this doesn't mean that the company is actually going to stop working or to stop growing. But the steady state just refers to when a company is effectively growing in line with the economy or at the same pace as the overall economy. In other words, they are growing at almost the same pace. Because there are so many competitors that came in, even at a certain point that you can be able to determine the next month or the next quarter sales. Because you'll find that these sales are not going to be changing over time. In other words, the change will be there, but it is just almost the same, which is not the case at the point when the company is still growing. Because when you start your business, you've gotten the market and people are buying, the company is growing at a faster rate, but it reaches at a time when other people realize that these guys are actually making profits and they join the business. Just like the way you've seen that we had Coca-Cola taking up the world. You've seen Pepsi coming in, meaning they have started producing almost the same products. So the market is now shared. There are other companies that keep on joining, like Harris International. You find that there are other companies that are coming in. So when they come in, it reaches at a point that the company is going to be almost selling, or almost its sales can actually be forecasted exactly. In other words, someone can say, today we've made 2 trillions. So tomorrow we might make maybe 3. This month we made 3 trillion, so next month it may be 5. But the difference is actually not all that high. In other words, that's the time that we say that a company is now growing almost at the same space as at the same pace as the economy. So that's what we are referring to, that stage. So when a company reaches a steady state and start growing in line with the economy, that is the point at which part 1 has ended and now part 2 has begun. In other words, if you reach at the steady state, maybe you can actually approximately guess that next month we shall sell this. It means it's almost constant. It's like you are getting almost the same sales year after year. So you find that the moment you reach that steady state, or you have reached the climax, we expect, if the company is not going to be managed well, you will fall. But if you don't fall, then it means you are going to maintain that same level. So when you maintain that same level, it's where we look at the terminal value, because it will be almost the same that we will get this year, the other year, the other year. That's when we can finalize and we can be able to compute the terminal values using the terminal growth rate. So part 2, which is the terminal value, is the part of the valuation. This part 2 here is that part of valuation which continues indefinitely in the future or forever, but it's not practical to forecast cash flows forever in a financial model that has a limited width. We've said when we are using Excel, we find that Excel has approximately 16,300 and something. Those are the columns that are within our spreadsheet. One worksheet has that. So what we do is we use a growing perpetuity formula. We use the growing perpetuity formula. because there is no way we can, it's not practical for us to forecast forever. So we use the growing perpetuity formula, and that formula is the one that we are going to use to value the perpetual growing cash flows. So now we have a basic overview of these two parts, because what we've just seen is actually the basics. But since these are going to be very important as far as financial modeling is concerned, we need to have these practical computations. So since we have now gotten the basic overview of these two parts, part one, the company is growing faster than the overall economy. In other words, that's the period when there are so many customers and the products are few. Even the production lines are not actually working. Even if they're working at full capacity, but the demand is there, they can't complete it. And now, in part two, the company grows in line with the overall economy. In other words, it's growing in that same pace indefinitely or forever. So what we will do now in the next video, we are going to dive in and we look at each of these two parts so that we can understand exactly how all the mathematical calculations work and how are we going to construct our model. So in the next video, we are going to start off by looking at the discrete forecasts. So let's meet in the next video as we look at the discrete forecast. Thank you for watching. Hello viewers, welcome back. We are now looking at discrete forecasts. Now as we discussed, there are two parts or two components to a DCF valuation. Number one, we have the discrete forecast, and number two, we have the terminal value. And what we are going to discuss here is something that we have to discuss. So something that we are going to discuss here, it is this item here that is shaded in blue. These items here, these ones that are shaded in blue, they are the ones that we are going to talk about. Whatever you see that is in blue is something that we are going to look at. Whatever is shaded in that blue is something that we are going to focus on as our discrete forecasts. And that's our part one. So whatever you see that is shaded in blue is the discrete forecast. And as you can see, we have a constructed model here with discrete forecasts of 5 years. So we have the discrete forecast period of 5 years. And what that means is that we expect the company's growth to exceed the overall economy for 5 years. In other words, we have to exceed the discrete forecast. They are starting from this point, those 5 years. And we expect that in those 5 years, we expect the company's growth to be exceeding the overall economy. And after 5 years, this point right here, after 5 years, we expect the company's growth to be going at a steady state or in line with the growth of the overall economy. As we can see, forecasting these unlevered free cash flows forecasting those unlevered free cash flows from year one, forecasting these unlevered free cash flows from year one, from here up to this point. So forecasting from year one to year 5, you can see they are all shaded in blue. But we really want to focus our attention down here to the bottom where we show the present value. We want to focus on this side here, where we show the present value of the present value of the discrete forecasts of $50,623. And now, the reason as why we are focusing on those is that in order to calculate this present value of $50,623 US is best or is computed using the NPV, net present value. In Excel, there is that net present value formula. If you put in that net present value function, it will be able to compute these values right here, and you'll be able to get this value here. Now, the first thing that the NPV function will ask you is the rate. And the rate is actually our discount, the discount rate. And the discount rate, we said from this point that it's going to be our work. This is the discount rate. So this is our discount rate, the work, weighted average cost of capital. And that weighted average cost of capital as our work is 13.5%. So the next thing the NPV function asks you is asking for the values. And for the values, we are using the values shaded in green here. These values you are seeing from here, they are the ones in green. So these values that you see here, that are within the green, they are from those functions, as you can see, from those values or from those tables as you can see them. So these are our discrete values, as you can see. Now, what the NPV function is doing, it is actually helping us, is taking those cash flows, these cash flows here, the cash flow profiles, and it is taking those cash flows and discounting them back at a rate of 13%, 13.5%, that is our work, in order to get the present values. Because you know, from the NPV itself is just getting, it gets a cumulative total, a cumulative value. In other words, the cumulative value is this present value that you are seeing here. If you discount all these values here and you sum their discounted figures, you'll be able to get that figure of around $50,000. Now, the NPV function asked us about the discount rate. It also asked us about the values, but it never asked us anything about the timing. In other words, what do you think is the logic there? Because the NPV function never asked us about anything to do with the timing of those cash flows. And we said the timing of the cash flows, the timing of cash flows is really important. It never asked us the timing because it assumes, or that function is making an assumption about the timing, because it was never asking. It never asked us the timing of those cash flows that we've we've seen. So the implication is that it must be making an assumption for us, which it based on to have those values computed, because there is no way you will not understand when these cash flows are coming in if at all you don't ask for it. So since it doesn't, the NPV function doesn't ask for that, it means it makes an assumption. So we want to look at what was that assumption, or what is the assumption the NPV function makes. So from this diagram here, on your left hand side, sorry, on your right hand side here, you will be seeing the values that we have there, but it will help you understand how the NPV thinks about timing. So when we feed in the first cash flow in here in the NPV function, the first cash flow here as the value, let's say this one, let's assume this is our first cash flow. So our first cash flow, when you put that cash flow there, so if you feed that first cash flow, the $12,500 into our NPV function, it automatically gets discounted back by 1 year. So it will be discounted back by 1 year. The second cash flow here of 13,900 gets discounted by second year, meaning these are going to be assumed in that perspective, and even these other ones, they will be discounted in that same perspective. So the point here is that these cash flows, the way the NPV function works, it is by default that it takes the first cash flow to be discounted in that same first year, or it is discounted back by 1 year. The 50 cash flow, which gets discounted back by the 50th year. And this is the way the NPV function works. It's by default. So one advantage to the NPV function is that it is relatively simple and faster, because we don't have to enter in any assumption with regards to the timing of the cash flows. But now that's also a disadvantage to that same formula, because the NPV function, we don't have any control over the timing of the cash flows. In other words, we can't control the timing of the cash flow, and at the same time we can't have control over the valuation date. So that's one of the disadvantages. Though it helps you to finish some of these things faster, but it's at a disadvantage, or it's disadvantageous to the model, because we can't have control over the timing of the cash flows, and even the valuation date itself. So let's make sure that we understand things from a timing perspective. We need to understand things from a timing perspective, because if you don't understand the timing, then it means you will not be able to have these cash flows. Because if you have the wrong cash flows, you will be able to get wrong results, and that's the problem. Because some of them, they will be using this NPV function and they forget that it doesn't look at the timing of the cash flows, especially when you are using the NPV function in Excel. So I want us to make sure that we understand things from a timing perspective. So if we think that the cash flows in year one are actually happening at the end of the year, then the NPV function will discount those back by 1 year, and thus giving us a present value at the end of year 0. In other words, for the cash flow that is coming in year 1, let's say 12, this first one of 12,500 is coming in year 1. So if we are to discount this back using this work here, we shall be getting the present value at year 0. That is the implication, because we are discounting it back. So if we thought that the cash flows in year 1 were happening mid-year or in the middle of the year, because what happens, these cash flows here, we've assumed that they are coming in at the end of the year, and we shall also get the present value end of year 0. But now with the assumption that the cash flows are not coming in at the end of the year, but they are coming in the mid of the year, what happens to that? Because these cash flows, they are not coming in at the beginning and they are not coming in at the end. That would mean the NPV function gives us a present value in the mid of the year, and that is year 0. So understanding the timing of the cash flows is absolutely critical, and for this reason we are going to spend more time on this as we progress through the course. For now, let's move forward and take a look at part 2, which is the terminal value. But I want you to get this clearly from the timing perspective, because I'm going to repeat this because I want you to pick me right. From this point here, from that box on our right hand side, we want to make sure that the NPV function we are using, it is actually giving us the right present value as at the timing perspective. In other words, if the cash flows are coming in the middle of the year, let's just use year 2. They are coming in the middle of, let's say, year 2, June, maybe in the month of June. So the thing is, we want to make sure that the NPV we use, all the NPV function we use, because this, for you to get the present value for this, the present value will be the PV, that is the present value, will be in year 1, but it will be in the middle of year, in the mid of year 1. In other words, the NPV we shall use should make sure, the NPV function should make sure that it gives us the NPV for the timing of mid-year 1. If it is at the end, if the cash flows are coming at the end of year 2, if they came in the end of year 2, then we are supposed to get the present value of year 1, meaning it is at the end of year 1. If it is coming at the beginning of the year, we shall get the present value at the beginning of the year, meaning we should take note of the timing perspective of the cash flows. Otherwise, this is what we are going to focus on, to insist on as we go through the model. But for now, let's go to the part 2, which is talking about the terminal values, and we first understand the terminal values. So let's meet in the next video as we are talking about that. Hello viewers, let's now focus in on the second part of valuation, which is the terminal value. That's our second part, terminal value. This one right here, the terminal value. So let's focus on that terminal value. And this diagram here will look the same as the last one we had, but we are focused on year 6. So our focus here is on year 6. That's where we are going to focus, where we have a forecast for unlevered free cash flow. So this is the forecast for unlevered free cash flow. It is the one that we've now put in black, sorry, in blue. So they are the ones that are highlighted in blue. And now we can see that unlevered free cash flow of 17,200 US dollars in that year 6 for the unlevered free cash flow here. We are going to make use of these other two values, these ones here, the terminal growth rate of 2% and the weighted average cost of capital of 13.5%. This one right here. So those two values that you can see from this box here, that small box, those two values that are there, we are going to use them. So what we are going to do in this part of valuation is we are going to make the assumption that unlevered free cash flow, this one here, the assumption that we are going to make is that this unlevered free cash flow, this one right here, the one of $17,200, is going to grow forever at the rate of, it's going to grow at the rate of 2%. That is the growth rate. So this rate of 2%, it's going to grow at this rate of 2%. The growth rate, we refer to that 2% growth rate as our terminal growth rate. And we are going to, and what we are going to do is we are going to use a growing perpetuity formula. In other words, the growing perpetuity formula. This is the growing perpetuity formula that you are seeing. Growing perpetuity formula. So that's the formula that we are going to use, whereby the present value in year 5 here, the present value for this year 5, the PV for year 5 of year 5, the present value of year 5 there is going to be equaling to the cash flows in year 6. The cash flows in year 6, this 17,200 divided by R, and our R is the discount rate of 13.5% minus the G, and our G is the terminal growth. The G is the terminal growth, R is our work, and CF6 is the cash flow in year 6. So when we divide that, we shall get the present value of year 5 as $149,565. So that's the formula that we are going to be focusing on. So I've tried to feed in the cash flows in year 6, and we've divided that by the discounting rate minus the terminal rate, and that's going to provide us with the present value in year 5. So this present value here that we've gotten, it's supposed to be in year 5. So we've divided the 17,200 by the 13.5% minus 2%, and it gave us a value of $149,565. And we can see this very figure here in this row here, this one in blue. You can see this value here in blue here. That is the terminal value. So that's the value that we are going to have. Remember, the reason as why we are putting this, we're not putting it in year 6, is because we are discounting from year 6. Remember that our discrete values, they stopped in year 5, meaning it's that year 5 that when we discount this cash flow of year 6, cash flow for year 6 will be brought to year 5. That's why you are seeing that cash flow, that present value, we've put it in that year 5. So you are seeing that value in the table here. We've put it there. Now, one of the critical things to understand from this formula, in other words, one of the things that we need to understand from this equation here, this equation that we have here, one of the critical things that we need to understand in that equation is that a lot of people forget that when we input the cash flow of this year 6, the 17,200 in year 6, and run it through the formula, it gives us the present value 1 year prior to that. That is very important. So it gives it, in other words, the value that you are seeing as the end result of 149,565 US dollars is for the year 5, not for the year 6. That's what we need to understand. And another way to think of this is that this perpetuated growth formula here, this perpetuated growth formula always gives us 1 year of discounting. In other words, if you are discounting a value or a perpetual growth value, it only gives us a 1 year of discounting. In other words, we can't discount this cash flow in year twice, that we discount this and we put it maybe to this point. No, it is only single year of discounting. So as we discount from year 6, we have to put it back to year 5. That is 1 year of discounting. But what we need to do now is we need to get that year 5 cash flow amount. So the year 5 cash flow amount all the way back to our valuation date. And that's what we are going to do in the next step. Because you are seeing this figure here, this figure that we have here, we need to put it back to our cash flows. Remember, these are our discrete cash flows, and they were going up to year 5, meaning there are some values that have been added on that last year of year 5. So by bringing this figure back to our cash flows that we are discounting, we put it in year 5 and we add them so that we can get the total cash flows. They are the ones down here. So these total cash flows that you are seeing here, these ones here, they are the ones that we are going to use. So let's now move forward and concentrate on getting the cash flow of this 149,565 US dollars back to year 5 for, because when you put it back to year 5, that is to our year of valuation, that is our valuation date. We can now bring this table here. This table right here is the table that we are going to use now. So again, this table, we are going to focus on the present value of the terminal value. In other words, we are going to focus, our focus is going to be on this value here, the present value of the terminal value at the bottom. So since we are picking this value back, because these are going to be the total cash flows here. Since we've gotten these total cash flows, these ones here, and now we discounted these total cash flows back to our valuation date. Let's assume that our valuation date is this 2024. And now these years we are starting from maybe 2025. If you add here, then this one is 2029. Let's assume like that. And now we discounted all these cash flows that we have here, and we gotten their present value. So their present value was equating to this, and that was equaling to our enterprise value. But remember, we had already discounted these ones. The first one, this one is up. We had discounted these ones for the discrete, and they gave us 56.23 US dollars. So the issue here is that if we discount this one, the 149,565, we discount it back to the present, and now we get back to our present value, this figure here, which is 79406. So it is these two values, when you sum these ones, this one and this one, they will give you what we call the enterprise value, EV. So that's the kind of mathematics that we are trying to have in place. So that's what we are trying to get. So now that we've seen those values, we've been able to look at this terminal value at the bottom here. At the bottom, the terminal value of that figure, 79406, and that value we are going to deploy we deployed the NPV function. So that will look similar like to the last time we did. We've gotten this value and we took it back using the NPV function, and we've gotten in this one. So what we are going to do here with the NPV function, we've put in all those values. So with the NPV, actually, you come and put in all these values here. So these results here that we have here, they are the present values. So when we sum up the present values for the discrete plus the present value for the terminal, we get what we call the enterprise value. And that enterprise value will be the value of the company, which is roughly 130 US dollars, 130,000 US dollars. So in the next discussion, we are going to talk about the enterprise value and how we can go even further and get to the equity value. Because the enterprise value is for all, it is the value of the business, including all the equity providers and the debt providers. So we are going to use the enterprise value. We go back to the equity value, but you've seen how we've gotten the enterprise value is by looking at the present value of the discrete values or forecasts and the present value of the terminal value. When you sum them up, you can be able to get what we call the enterprise value. So we see you in the next video. Hello viewers, welcome back. We are now looking at the enterprise value and the equity value. So what we have done in the last exercise is we've tried to calculate the enterprise value. We've calculated the enterprise value for the company, and you can see here on the right hand side, this side on the right hand side, we've computed that enterprise value. We've computed that enterprise value, where we have the enterprise value of roughly 100 and we have the enterprise value of 130 from this point here. This is where our enterprise value is 130. Now, the enterprise value really represents our view of the company's value. In other words, we are the ones who've computed this, who have done the valuation. So we've gotten our enterprise value as per our computations. Now, that is going to represent our view of the company's value. So if we have built the DCF model and the DCF is telling us the enterprise value, so if we have built the DCF model and the DCF model is telling us the enterprise value, then that's really our own view of the company's value. In other words, the computations we did, those are the as per our computations. Now, although the enterprise value is going to be a key metric that we look at, and it is easy to use it to compare against other companies, it also might be interesting for us to calculate the equity value. And the way we are going to compute the equity value is we are going to take the enterprise value, we subtract the net debt, which is roughly 34,000 US dollars, and that will give us an equity value of around $96,000, this value here. So it is really great to think about a piece of real estate. Let's try to think about this in terms of real estates, because it will be the one that will help us to understand the difference between enterprise value and the equity value. If we owned a house that was worth if we owned a house that is worth $130, so meaning the whole house is worth $130, then the net debt is like the debt we have, let's say, to the mortgage. Let's assume that maybe we have a mortgage of 34,000 US dollars, and that's the mortgage that we have. And that would mean that this net debt, or in other words, the debt is going to be offsetted from the 130. So for us to get the equity portion, we shall get the enterprise value of 130, we less off the debt or the mortgage of $34, and this will give us 96,000. These are dollars. So that $96,000 is the worth of the equity section in the house. In other words, we borrowed 34,000 US dollars, but we have a house that is worth 130 US dollars, meaning the 96 is actually equity. So that's the implication from that perspective. So that is the implication of that. And another way you can think about equity value is actually it's our residual value as owners. What has remained after we've cleared all the dirty components? For instance, if we were to sell the house, let's use another scenario here. Same information, but in a different perspective. Our house, we will say that our house is worth we will say that our house is worth that is the house, and it is worth 130 US dollars. We find that we are now going to pay off our mortgage. We can sell this house at 130 US dollars, but we can pay off our mortgage, the debt of 34,000 US dollars. And that is going to leave us with a residual amount. And that residual amount of $96,000 is worth our equity. In other words, that is the residual amount that has been left there. Now, we want to also make sure that we understand how to calculate the net debt, because we have understood how to make these computations for the equity. But now we want also to look at this scenario of how we can be able to compute the net debt. The net debt, actually we have a formula here. For our net debt, the formula is here. Now, we have up here on the top, this top right corner, we have taken a debt of 45,261. This is the debt. And now we've subtracted our cash. Cash is 11,246 US dollars. And that gave us a net debt position of 34,015 US dollars. That is the net debt position. That is the net debt position that we are in. Now, the way to think about this net debt is, if you had 45,000 US dollars worth of debt and you had cash, maybe you went and bought 45,000 US dollars, but with you had cash of 110, 11,000. Let's just take 11,000 of debt, of cash. Now, you could use the cash to pay off part of the debt. This cash that we have, the 11,000, you could use cash to pay off part of the debt, because you borrowed 45,000 and you have cash of 11,000. And you could use that cash to pay off that portion of the debt. And that would leave you with a net debt of 34,000 US dollars. Just take it like this. You have a loan in the bank and you've gotten some cash. They are demanding you 45,000, but you've gotten cash 11,000. So the whole idea is that you go and pay off the cash you have to the loan, towards the settlement of that loan, and you remain with the balance of debt. In other words, the net debt is equaling to the total debt, all the debts that we have, total debt minus whatever cash we may be having. And that will give us what we call the net debt. That's what we are seeing from this point here. So that's how great you can be able to think about that net debt. Now, let's take some time and look at the equity value. We throw more lights on the equity values to see what we can actually have from there. So now, equity value we want to look at equity value. So equity value, we normally find this under public companies. So public companies can be more complex than pieces of real estate, as we've clarified earlier, in a sense that public companies would have shares outstanding. They have shares outstanding. So if we go forward, we might want to understand equity value as, first of all, the value that the equity holders are entitled to. But we might want to look at how to calculate the equity value per share. The equity value per share. Just know for equity value, that's basically the shares, the equity or holders, what they are entitled to. Now, what we would do in this case, if we are trying to get the equity value per share, we would take the total equity value, we divide it, this is total equity value, we divide by the number of shares outstanding. In this case, we could see that roughly 25, these shares outstanding, they are roughly 25,000 shares, and it would give us an equity value per share, which is roughly 3.7 per share, the equity value per share. Now, if we have gone through the process of building the DCF model, and we have selected the input that have gone into that model, then this 3.7 you are seeing from this side, 3.75, represents our view. The 3.75 represents our view of the company's equity value per share. But what we can do as a final piece of analysis is compare our view of equity value per share of 3.75, and we can compare that to the market price, what is prevailing at the market. We'll compare that with the market price or the current share price. We've seen that the current share price here was 3.14 per share. That is the equity value per share, the current or the share price per share. Now, we can now see that here our view of the value is 19.4% from this side, higher than the value where it's trading in the market. In other words, when you get the 3.75 minus the 3.14, that is 0.61, that gives you a percentage of 19.4 of the, meaning it is already higher than the value we are using, or that is the value that is prevailing in the market. Meaning, we valued our company and we found that our shares are actually 3.75. But when you go to the market, they are actually buying those same shares at 3.14. Meaning, For us, we overstated our values by 0.61 cent. In other words, by 61 cents or 0.6. So, meaning our value are now higher than the market value. So, what we have really done in this process is we have calculated our own view of the company's equity value, and then we have compared it to the stock market price, and this is where we could encounter an opportunity. It's either we get an opportunity or we find it's a loss. Because if our view is correct and the stock market is incorrect, then we have the opportunity to make more profits of 19.5. Because what does this mean? What this means is that this percentage you are seeing of 19.45 is actually making us to have a profit. That's why you are seeing we have a premium of 19.4%, and that premium comes as a result of these small differences that we are seeing here. So if this is our view, if this one is correct and this one is wrong, the implication here Hello viewers, welcome back. We are now starting off our chapter 2, and this is the compact DCF model. And video number 1 is going to be looking at the keyboard shortcuts. That's basically what we are going to look at in this chapter 2. You say this is chapter 2 of DCF valuation modeling course. And as our chapter 2 compact DCF model, we are kickstarting with our video number 1 as keyboard shortcuts. Video number 2, we shall look at the model structures. Video number 3, we shall look at formula building, and we'll proceed to the rest of the videos that we shall be having in our discussion as far as chapter 2 is concerned. So, without wasting more time, let's dive in and get started. All right, as you can see, we have the template open for the DCF model. That is our compact DCF model. As you probably know, we are really big fan of using the keyboard to operate the computer, especially when we are working in Excel or when we are working with a financial model like this one. Now, if you haven't started experimenting with the keyboard, you really should. It is just so much fun and faster and even more accurate than using the mouse or the trackpad on your computer. So let's start with a little demonstration just to get you started, and we see what we have. Now, we are going to do some bit of demonstration on the things that we may look at. Let's suppose that we want to take some of the cells on this cover page. The whole of this is our cover page at that point. That is our cover page. Now, let's try and assume that maybe you want to take some of these cells on the cover page and we change their fill color for them. What we can use, we can now try to use the arrows to navigate within the section of their cover page. So let's try to use the arrows to move using that navigational column. We are using now the down arrow to move around, and we are going to, maybe we start from this row 19. We start highlighting because we want to highlight a bunch of cells. Maybe you can highlight from this point, that's cell F19. Can use the shift key and then the down arrow to highlight. Maybe we go up to that point, that is F24. Then we can also proceed to this, maybe to that point. As you've seen, we've highlighted these values, or this bunch of cells. As you can see from there, these are the cells that we've highlighted. So what we want to do to this section, we want to make sure that we actually get these values and change their fill color. So what we are going to do, since we have highlighted the section that we want to change the fill color. Now, for a person using the mouse, you would probably be inclined to drift up here in the Excel ribbon, this side, in the home section of the ribbon. Then you have to move over to here where it says fill color, and you come and click this down arrow that you're seeing next to that icon, and when you click there, you're going to see that that small down arrow that you saw there, it opens up a palette of possible colors that we could select or that we could click into. And that's one way when you're using the mouse. But as we said, we are big fans of using the keyboard. We are going to leave this for now, and we are going to focus on looking at the alternative way how we can be able to do that by going through the Excel shortcuts. Now, let's try a different way using the keyboard. And now, the key to learning the keyboard shortcut is making use of the Alt key. So what we are going to do now, we are just going to tap that Alt key. So you can try to remove this to have that in focus. So when you hit the Alt key for the first time, we are going to see all these letters that you are seeing. These letters will appear across all the menu. Now, we want to access the home menu or the home section. So we are going to tap H, and that H is going to bring some new colors. You are seeing that those set of new letters comes up, and what we can see right here is we have the fill color here. For fill color, we are seeing that we have that letter there, H. So now what we are going to do is tap H again, and it will bring to that section. You'll see that it opens up this palette of different colors. And what we are going to do now is just use the arrow key to use the arrows that we have on our keyboard to move over to this blue. Maybe we just want, let's just use the arrow keys. We just move downwards. We can now pick from our standard colors here. You will be seeing that whenever you be moving around, these colors are going to keep on changing. So you'll be able to select which color you actually like to use. So what we are going to do, we are going to pick this blue one. Maybe we can pick that, and we come and hit our enter key. And you will see that that color has been displayed there for those bunch of cells that we have highlighted. Now, we have that fill color for those different cells, and we've gone through that by using the keyboard. Now that we may have seemed very fast, but the keyboard becomes so quick once you learn a lot of these keystrokes. Because if you are familiar with your keyboard, you can actually be able to learn how to use some of these shortcuts better. So let's just do another quick example. Let's suppose that we want to remove the fill color from these same cells that we've just put the fill color. So what we do, we highlight them. Maybe we can start from this point, hold down the shift key, highlight with the down arrow, highlight then across with the right arrow. So we have highlighted that section, and what we want to do is want to make sure that we remove the fill color from those cells. Again, we will hold down the shift key just to highlight those area, this area that we've selected. That's the area in the blue font. We are going to tap the Alt key, and what we want to have, we want to go for H again for home, and then we want H another time for the fill color, because our fill color from here we have letter H. So we tap H again for our fill color, but now we want to move down at this bottom right here where it says no fill. So you are seeing where it says no fill, we have N. So what we are going to do, we tap the N key, and when you do that, it has removed the fill color, and that is super quick, because we can see we've just used the small shortcut To actually have that, it was Alt key plus H for home plus H for fill color and then N for no fill. That is the shortcut for removing the fill color. So that's what we have there. Now, since we've just done that, so if you want to just get, so you will see that if you're just getting started with the keyboard, it may feel a little bit uncoordinated and awkward and even slow for the first couple of days. But if you keep doing it, it will get really faster. For instance, if you want to change the fill color, you just select any cell. Maybe we just shift right arrow and then the down arrow. If you've selected that, what you just do, you just come here and say Alt H, then you put in the color you want. You use now the down arrow to move along and put in a color that you may be interested in. Then you hit enter. You've seen it has actually done that very fast. It will actually change the fill color in just a minute. Now, what we want to do now, we want to remove the fill color. So it is also quick, because what you have to do is go to your Alt, because the figure is still selected, Alt, H for home, H for fill color, then N for no fill. And you find it has removed that super quick. So that's what we got from there. So let's get this removed. So now, since we have removed that, we can now go to another thing. Now, one other tip that we love is a little thing that we do to maximize the amount of the real estate on our screen. In other words, the amount of space that we have here on our screen. Now, we can see that the Excel ribbon up here, this Excel ribbon up here, the whole of these items that you see that comes up on this area, whatever that is on that same area, it is actually the Excel ribbon that is actually trying to take some bit of space from our working area. Now, this Excel ribbon that you've seen at the top, it takes quite a bit of space right across the top of this monitor. Now, if you want to make sure that you have that removed, what you just do, you just use this shortcut, you just Control plus F1. Control F1 will actually make that disappear. So let's try it. Control F1. F1 is just next to the X to the escape key in your left corner of the keyboard. So you can see that Control plus F1, it has acted as a toggle that keeps that ribbon on and off. Because if you go back to Control F1, it will bring it back. Control F1, you'll find it has come back. So it acts as a pivot point to make sure that we have that either displayed or non-displayed on our computer or laptop monitors. So we could just go like that and we toggle it off and on and create a lot of more space for ourselves. Now you can see the space has increased. So when you put it on, Control F1, you find that it has captured some space. We can only see up to row 16. But if we push, we remove it, Control F1, you'll find that we can also see up to, say, row 20, meaning it had taken over 4 rows and we couldn't be able to see them. So that's why you can use that to toggle those off and on, so that to create more space for ourselves when we are working in Excel. Now, you might worry that because now if it has been removed, someone may be worried that since it is removed, I'm not going to be able to access the things that are in that ribbon. But in fact, if you're using the keyboard, you can still access those features that are within that ribbon super easily. And again, if we are to go to the Alt key, so we see those letters appear for all the menu. Like for home, for example, we have H here for home, N for insert, P for page layout. So we can see the different things that we have there. Now, if we want to tap H, it makes sure that it brings that ribbon back. It brings the ribbon back or it expands the ribbon downwards, so that you can actually have a look at those features. So it means you can be able to see those things. So once you are finished with what you are selecting, then it can go back and collapses. As you are seeing, it has collapsed. So if you're using the keyboard, you can actually access those things that are still in that ribbon. So that is going to create a big space for our work that we are doing. So the other thing that is really nice when we are working in large financial models is to be able to quickly zoom in and zoom out to bring everything perfectly into focus. Now, one trick you can do with your mouse is you can hold down the control key and then roll the mouse wheel. If at all you want to navigate and you want to navigate using the mouse, you can hold down the control key and then roll your mouse wheel, and it will allow you to quickly zoom in and zoom out. But now, for us that are focusing on the use of the keyboard, there is also a shortcut for us to actually have that in place. So what we do, in order to activate this similar command with the keyboard, we have to hold down our control key and alt key all together, and then we can use plus or minus. When you use plus, you are zooming out. When you use minus, you are zooming in, to have like the way we can have those items in focus there. So that's what you can do on your keyboard. Just like this, you'll be able to move in and move out in a nice way without using your mouse. And you can actually see what we are doing. So if you try to hold down the control key and the alt key, you use minus, you use plus to increase, you'll be able to see that from down here, this point here, you'll see that the zoom level here is going to be increasing. If you use the minus, it will be able to decrease, as you can see. So we are seeing that we are actually having those zoom parameters changing within Excel. So when you look at this point here and you try to zoom in and zoom out, this point right here, you can actually be able to see this whole side here. You can actually be able to see that zooming level that we have. You'll be able to see when they are increasing and when they are reducing. So you can actually see that we have those in place. Now, we can see that we have those perfectly working. So, in the next video, we are going to give a quick tour of this same model that we are in. Because right now we've been focusing on our cover page alone. But we also have the model itself here. Because we have another tab. Or because we say the tab is the same as sheet or a worksheet. And a group of sheets, they're actually called workbook. You find this is one sheet, but in one workbook, you may find there are very many tabs or sheets. So that's what we have for now. Let's meet in the next video and we'll look at the model structure. We'll see you there. Hello viewers, welcome back. We are now looking at the model structures. So we are still on the cover page here. This is our cover page, and this is our sheet 1, the cover page. But as you can see down below, if we just highlight with the mouse here in tab 1, this is our tab 1. You are seeing that it says cover. This point here, it says cover. That meaning that's our cover page. And now the second tab, if you look at the second tab here, it says model. So this is our second tab here, the model that we are in. This is the second tab. You can actually add as many as you can, because if you click on this plus, if you put your mouse on that plus symbol there, it says new sheet, meaning you can add another sheet and you rename it according to what you want to do with that additional sheet. But for now, let's just be with those two tabs that we have. And we said a tab is the same as sheet. We spoke about these things in our introductory part. So you can check out our previous videos. You'll be able to understand some of those different definitions that are there. So we can see we have those two tabs. But now, since we don't want to be using the mouse, we just want to be able to navigate over to this model tab here, going back to the cover page to the model tab without using the mouse or without reaching for the mouse, so that we can just be navigating like this without clicking on these points with the mouse. So how can we be able to do that using the keyboard? That's what we want to do. Now, the way that we are going to navigate from one tab to another with the keyboard is we are going to hold down our control key. We hold down the control key. You hold down control key. Plus, now we are going to use the either page up or page down buttons. page up or page down, any of those two. If you hold down the control key, you hit the page up, it takes you to the first page, that is the cover page. Then if you hold down the control key and then you hit the page down, it takes you to the model tab or the model sheet. So that's how we can be able to navigate back and forth between those two different sheets. So those two buttons can actually help you to navigate back and forth just like that. Now, this is a great shortcut and we are going to use it all the time. But you have to be really careful that you don't accidentally hit the shift key in the process. Because if you happen to hit the shift key in the process, then you are going to have a different issue. So what will happen if I hit if it happens and you hit this shift key accidentally, this is what is going to happen. Let's first remove this. Let's first delete some of this so that we can clear our space. Now, if you hit that shift key accidentally along with those control and the page up and page down buttons, this is what is going to happen. So I need to maybe to clarify or to give you a demonstration. If it happens and you come here, you hit the control key plus, then accidentally you hit the shift key, then plus either page up or page down. This is what is going to happen. Now it depends on which sheet that you are on. For now we are on model tab. So if you just watch that small demonstration where you hold down your control key and you are going to hold the shift key together, maybe you accidentally hit it together and you use either page up or page down. So when I use the page down, it doesn't work. Reason is because if I want to move from the cover page to the model, I use control page down. But I'm supposed here now to use the page up. If I use the page up, it means I've highlighted those two sections. You are seeing that from this point here, this section here, we are seeing this cell and this tab and this tab, they are actually combined. They are combined all together. Now, what we have done now is actually we have highlighted both those two tabs, the cover page and the model tab or the model sheet, and that's called grouping. And in fact, if you can see right up here, if you go up here, we have KC Accountancy Education Center, Dcf Valuation Compact template for lectures. Here in the bracket we have group, meaning it has been grouped. That's why you're seeing even the file name has changed and it has put group. So that's why you are seeing this side, it says group. From this point here, up here, it says group. And the reason why it is saying group is because we've highlighted those two tabs. And that process is what we call grouping. So what we have done, we have grouped those two sheets together. The reason this can be dangerous is because if now maybe we do anything to one of these tabs, it's also going to happen to all the sheets or the tabs. In other words, one small change to one tab, it will affect the other. So if you type in something, it's going to appear on both two tabs. So you can cause a lot of damage in your financial model if you accidentally group your tabs together. So what we are going to do is we are going to hold down the control key, and now we are going to use we are going to hold down the control key, then the down arrow to make sure that we have that ungrouped. So as you've seen, we have tried to ungroup those, and now you can see from this section right here, you are seeing that those values are actually not grouped as they were. Even the narration that we had at this point here, it has actually disappeared. So we are back to our settings as we wanted it. So let's first delete this. So that's what we had to talk about, so that we can actually be able to understand that. So what we want to do now is head over to the model tab. We want to be on that model tab, and again we want to hold down if now you've been maybe on this cover page, you can just hold down the control key, then page down, and you'll be set to go to that model tab, as we can see. So we would like to zoom in a little bit, and we have some focus here. So let's use the shortcut that we've learned a moment ago, Control Alt plus, just to zoom in a little bit to have those values in focus. Now we are going to be able to actually have this first schedule. Maybe we try to zoom in nicely, and we have this first schedule for unlevered free cash flows. Can try to have it in place. I think now we have that into focus. We can now see that we have the unlevered free cash flow, and it is now reflecting easily. Now let's start out by doing a quick little tour. We are going to be building up these unlevered free cash flows. So we are going to be building this unlevered free cash flow. So we are going to build it from that row 3. Hold down the shift key, we highlight across. So these are the things that we are going to build up to this point, row 28. So that's what we want to build up for now. We want to make sure that we have the unlevered free cash flows for this company up to that point. And then we are going to navigate down to fill. After getting these values in place, we are going to navigate down to these areas here for discounted cash flow schedule. So we shall fill out the discounted cash flow schedule from this point. Maybe we'll highlight also this. Go downwards to where it ends, to this point. There. That's what we shall do after finishing the first one. We also do the discounted. Maybe you try to zoom in. So that's the discounted cash flow schedule from row 36 to row 65, so that we can come up to the bottom and get the enterprise value here. Because now, if after getting the enterprise value here, we get the equity value per share, premium and discounts, premium, all the discounts to the company's trading up when compared to the current prices. So those are the things that we shall do from that point. And finally, we shall look at this point here, the sensitivity analysis. Right from row 74, and we'll move downwards until we finish these points here in this section there, 112, up to this point when we finalize here, 107, row 107. So we finish that schedule also there for sensitivity analysis. So that's the final section that we shall be looking at. So we can try to zoom in so that to see some of the things. Control Alt plus, just to have those in focus, so you can see the things that we are going to be looking at. Now, what we are going to do here, what we are going to be looking at here, so what we are going to be actually looking at, we are going to be plotting these values. We are going to have the ability to plot the enterprise value here from cell C86, these values here, we highlight using the shift key. We plot the enterprise value here for all those values, as you can see, up to row 94. We look at those values and we are going to plot them up to, and we are going to vary it for the different terminal growth rates and different values for the work that we have. So we are going to have those values filled all the way down to this point here, so that we can be able to get the equity value. Because we are plotting from the enterprise value, we get the equity value, and from that point, as you can see, we are going to do the same thing below for the equity value as you are seeing. We are plotting these values. They are also going to be against the terminal growth rate, the terminal growth rates for these periods. As you can see from here, even the work itself from this point. So we are plotting those values against that. And what we are going to have is we are going to use the values that we've gotten from this section for equity value. The values that we've gotten there, they are the same values that we are going to plot and make sure we get the equity value per share. So we are going to look at the sensitivity value, the sensitivity for the equity value per share, and then we move downwards to the current prices. So we are going to start from maybe this. Let's highlight these points. We look at all those values. For that, we move all the way down to the current prices, those points. So that's where we are going to, that's the kind of stuff that we are going to be going through. So we are going to look at the values for this, and those values are actually going to be connecting us to this point. And after that, we shall be able to get the values in blue here to be connecting us to this point of equity value per share. Then the equity value per share will actually take us to the last bit of it, and that's going to be the premium or the discount to the current prices. So that's how we are going to be moving. But everything is going to be plotting. We are going to be plotting the terminal growth rates that are on this horizontal line to this work. That is the weighted average cost of capital on this line. That's the y-axis. The same thing here, terminal growth rate, and even here. Even this side is the same, even here and here. All these values are going to be in these sections here. So that's what we are talking about. But we have the middle points here. We shall see what is going to be in those sections. So we need to look at how we are going to be able to have those values filled up. Now, we have done a nice little tour down below through the module. Of course, that's the end of the compact DCF. That's what we have there. It is just a small compact DCF model, but it's going to help us understand so many things. Now, the other thing that let's first delete out this. Now, the other thing that we might want to do is head up to over here in this column here, column A. Can move to the top here. That's our column A. Can highlight it. You can just come here and you hit your mouse for once, or you can just put in the cursor like that and use the control spacebar for highlighting a column. If you're highlighting a row, you use Shift space bar and you see it is highlighted. But for now, we are highlighting a column. So it is Control. Sorry for that. So in that section there, that is our column A. And we can see we've set up what we often refer to as a navigational column. You are seeing there is nothing in that place. And now, the thing that I want us to focus on is that in this same place, we've put in what we call the navigational, the navigational column. Sorry, it is a navigational column, but we've put in the little invisible stops. Like for instance, if we try to move for this section is called sensitivity. If we move to this point here in cell FA74, you will see that we actually put in, if you use the F2 to be in that cell, you'll find that we have a space. We put in a space there. It is an invisible space that we put in place right in that cell A74. So if you put in that space using the backspace, this big button like that, and you hit enter, those are invisible, but at least they make us to navigate through those different sections. These are already installed for you in that model that you received or you downloaded from our Telegram channel. Those, they are already there. So this allows you to stop at these locations where you find headings. So for instance, if we are in cell, let's assume that we are in cell, let's go back to this cell down here. If we are in cell, let's say 101, this one, A 101, and we want to go up to the next heading, we have now to use Control, then we hit the up arrow. You'll find yourself that you are going to be stopping at the sensitivity analysis, that is A74. And the reason is because of those stops that we put in there. If you go again and hit Control, the up arrow again, you'll find that the next stop is on the discounted cash flow schedule. If you do it again, then you use Control up arrow again, you'll find yourself on the unlevered free cash flows. Now, let's try to zoom out to get a little full view of this model. So what we can do, let's try to, we are going to use the Control Alt minus just to decrease our zoom levels. Control Alt minus. What we are trying to reduce. As I said, if you want to see the things changing, you will check from this point here. You will check from this point down here. You will see that those zoom levels are actually reducing. So want to get, just to have a snapshot of what we are doing. Control Alt minus, we take it maybe to 20, like 25%. That's when we can see that we are seeing everything in the model. We are seeing from all these sections, from this to this to this, and we can see that we've seen all the model all the way to the point where it ends. So we've tried to zoom in up to a 25% zoom level, and that's a much lower zoom level, just like the way you're seeing, so that we can see the entire model in one spot. Now we can see really easily that this model is constructed in a vertical fashion, which is the right way to build models. We really stack these schedules on top of each other, and the reason for this is that we can easily just link upwards and downwards in the financial model without moving from one tab to another. So stacking schedules vertically can really help to avoid potential leaking errors in the model. But then what we do in order to help us navigate in the model is we install this navigation column. That's why you're seeing this navigation column in column A. Can use Control spacebar. That column there is what we call the navigation column. And you can see right there in column A, we can just make sure that we hit the control page up and page down buttons. You will be able to move within the, when you hit control down button, you can go to the discounted, you go to that, you go to that until it's done. That's why you are seeing those different stops as we move forward. So that's what we are basically looking at. So now let's try to zoom back into our 100% zoom level. So we use Control Alt, then we are using plus sign to make sure that we zoom back to 100%. So now we can see that we see 100% from this point here. So we are seeing 100% from this point down here. The zoom level is 100%. You can see from there. So now that we have taken a look at what to do inside, now since we've looked at the model, now the next thing that we want to focus on is to make sure that we see what we are going to do from these shaded sections here. These ones from K11 to P11. Those shaded sections, this one is K14 to P14. So we see what we can do from those shaded sections, all the shaded regions within our financial model. We want to make sure that we fill those up. So let's see in the next video as we talk about how we can be able to give you a little guidance on how to fill. Hello viewers, welcome back. We're now looking at formula building. So what you are basically going to be doing in this exercise is filling in these cells. These cells which are shaded in gray. The whole of these cells that you are seeing which are shaded in gray, and we want to look at some of these values here. The things that are shaded within gray, those cells, these cells here, those are the things that we need to look at. Whatever that has been shaded in gray is what we are focusing on, these values here, this one here. So we need to get guidance on how we can be able to fill those values there. So that's what we are going to focus on. Now to get us started, one thing that you will want to try to do is use the mouse as much as possible and try avoiding the mouse if at all you can. So there are a couple of more keyboard tips to get you started. If maybe if you are going to do this completely with the mouse, here we want to go into this cell here, the cell K11. That's what we are going to compute. Now, if you are to do that using the keyboard completely without using the mouse, what we are going to do from that cell, we are going to take this EBITDA amount in J11. This value you are seeing here, this one here, is the value that we are going to take from this. So we take this value here, so it's going to be this value, it's going to be from this point here. So that's the value that we are going to take, and it's the value that is going to help us get the value that we want here in that cell. So what we are going to do, we are going to be in that cell, and one thing that we are going to do, we want to increase that value by 7.5%. The 7.5 is that value in this side here. We are increasing this value by 7.5 from this point here. So that's what we are going to do from here. So what we do, we put in an equal sign. We are going to use the keyboard. So if you are going to use solely with the keyboard, we put in an equal sign in cell K11, and what we want to do, we want to grab the EBITDA in cell G11, and now we are going to multiply. So we use the right arrow to pick that value, and this we are going to multiply by opening bracket. You first open the bracket, and then we say 1 plus. Now we are adding the percentage that is up in that cell K10. So we use the up arrow to move to that cell, and then we can close the bracket. So shift 0. So we've closed the bracket, and so that's the formula we wanted to enter from that point. It looks like the way you are seeing it on the screen. So that's the formula that we are going to use, and now we hit enter. You'll find that we have our value as you've seen up there, 19,757,000. Remember, these values are in millions. Here, our global units mark says all figures in US dollar thousands unless stated. So all these values are in that section. So now, if you're already accustomed to using the keyboard, the last demonstration may seem a little bit obvious, What you would also already know is that you can use the F2 key to get into a formula that into the formula that we've just used to make a modification on it. Now, for instance, if maybe you want to make modification to the formula that we've just put in, it is within that cell K11. So we put our cursor on that cell, cell 11, cell K11, and now what we are going to do, we are going to make sure that we have to modify the formula in there. So what we are going to do, for instance, we want to get into that cell K11. Instead of double clicking, because if you double click on this, you'll be able to get into that cell using the mouse. But now we don't want to double click on it. So hit enter. So what we want to do to get into that cell, we don't want to use the mouse. So we are going to just tap F2 key. And now it has taken us to the same where we've been. So it has displayed to us the formula that we have in there, in that place. J11 times open bracket 1 plus K10, close the bracket. That's the formula that we have inside there. So if we are comfortable with this formula, we can hit enter. Now, the issue here is that if we are not comfortable with the formula, we can make modifications to those formulas. Now, if you are comfortable with it, you just hit enter. And now it will display that. So it means we have gone into the cell and we've checked it without making any modification. Now, here is where a lot of people get confused or they get stuck. And then they start reaching out for the mouse. Because completing this section from this point up to this way is where people get stuck. And instead of just using the keyboard shortcuts, they end up using or looking for the mouse. Let's suppose that we want to actually, let's suppose that what we actually need to do is to make, we need to make a modification to this formula in cell K11. Now, since we are already in cell K11, what we are going to do, we know that we can tap F2 to get into that cell or to get into that formula. But let's pretend that we want to change this cell reference. So let's tap the F2. So we want to pretend that we want to change this cell reference, this one, K10, the one that we used up here of 7.5. And we want to change it maybe to J10, this one of 7.3%. What we are going to do, we are going to highlight this one. Inside here, highlighting inside here, that K10. Maybe you can try to zoom out. So what we want to do, want to highlight that cell inside there, that K10. So what are we going to do to highlight that? What we are going to do, we are going to hold down the shift key and then use the right, you use the arrows depending on where your cursor is. So you are going to be using the arrows. So hold down the shift key, then we can be able to move along there. We've been able to highlight that K10. So since we've highlighted using the left arrow, because my cursor was outside the bracket, so we've highlighted that cell K10. Now, what we are going to do, we are going to hit the backspace. The backspace has actually deleted that cell from there. So we first undo that. We can use also the backspace. We use the backspace because now if you use this bigger backspace, it will delete it and it will not display the cursor, but we want the cursor to be there. That's why we use the backspace, this small backspace, the one that has that backspace written on it. So we have the cursor in place there. Now, what we want to do is navigate around into the spreadsheet to find a new cell. And remember, the new cell is going to be J10. Well, when you try to use the up arrow, because now I can move using, because we are not going to use the mouse. If I use the up arrow and I hit the up arrow, you will see that your cursor is not moving anywhere, that you can't be able to navigate to the spreadsheet. Even if you hit the down arrow, you will not be able to move. Even if, but when you use the left arrow, you will see that the cursor is actually moving within. It's not moving out. It's just moving within the formulas. So, and you use now the up arrow, you can actually be able to navigate through the, you can be able to navigate through spreadsheet. So you use the up arrow. You can see now we can move out of that cell. And now what we want to pick this cell right here, J10. So the up arrow enabled us to navigate around and we can find that cell J10. And that's what we are looking for. So now what we are going to do, we hit enter. When we hit enter, we can see that we have now modified. It is asking whether we want to accept the changes. Yes, and now we've changed. We wanted it to be referring to this one. We know that what we've done is wrong. Now, so really, you can see that if you want to think about the F2 key, because what I want you to look at, I want you to understand that this F2 key not only help us to actually get into a cell, but it can also make a modification of that same cell by giving us a toggle between the different cells that we want to move to inside the spreadsheet. So in other words, it gives us operation between the cell, and we can actually operate within the cell, and at the same time we can operate inside the spreadsheet. So let's try to practice that one more time. Now, we have a formula in here, in this same cell. And the formula we have there, we know it's wrong. It's incorrect since it is referencing to the previous year's EBITDA. It is referencing to 7.3. Yet the actual thing should be referencing to, it is referencing to previous year, which is this 7.3%. But it's supposed to reference to 7.5, which is the current year that we are working in. So what we need to do, we need to make sure that we change that formula, and that's going to give us another try of how we can be able to use this F2 key, because it is really important, not only to help us move into the cell, but also giving us a toggle between the cell itself and the spreadsheet. So we are in that cell. What we do from that point, we hit the F2 key just to get into that cell. So if you want to move into that cell, you hit the F2 key, and now we are in. So what we are going to do is we are going to make sure that we move into that cell using the F2 key. Now, we are going to hold down the shift key, then we use the right arrow to highlight that J10 because it's wrong. We are supposed to have, it's supposed to be referenced to K10. So we hit the backspace key just to delete that. And now what we are going to do, we need to move out. If you want to move out to pick that K10, this one here, if you use the up arrow, you will not be able to move out. So you have to tap the F2 again to be able to use the up arrow and you move out of that cell. So from there, we are going to close the bracket and then hit enter. You are seeing we are back to where we were. So we've been able to change that 7.3 to where it should be referencing in cell K10 for 7.5%. So that's what we've done as far as practicing making that quick modification. So what we are currently seeing is that the F2 key has helped us to move inside the formula, and it has also helped us to actually move out of the formula, and we can be able to move in spreadsheet. So since we have now referenced the right value, we've done the modification that we wanted, we can now go ahead and do the rest. So what we are going to be doing in this exercise is obviously progressing all the way down through this financial model template and trying to fill out all these gray figures, these ones that we've not handled or we've not filled in yet, whichever that is in gray color. Those cells that are in gray colors, we have to fill them up. So we can be able to go through the entire template without looking at any of the other files and completely fill out this Excel sheet. Now, one thing that may be nice for many of you is to take a look at the PDF file. The PDF file is within we've supplied that within our Telegram channel that accompanies this. That file will show you what the completed model should look like and enable you to check some numbers like this very number here. From that point, you'll be able to see whether the formulas you entered there, they are actually giving you the right numbers as per the PDF. In other words, you check the number against the PDF, the value that in the PDF document or file, just to see if you are getting the correct numbers for the rest of the numbers. The other thing that we can do is you can check the complete file that we have also supplied in the same Telegram channel, and the link is attached to our YouTube channel in the About section. So you can go there, join the channel, be able to download whichever material you want from there, and you'll have to be able to follow along as we proceed. So if you really get stuck, you may need to get some assistance and look at how that was built. Remember to try not to use the mouse and try to do it all with the keyboard if at all you can. and make sure that you also subscribe to the channel, share to others, because there are so many things that we are going to have in place. Make sure you have the notification bell icon turned on so that you can be notified whenever we upload new videos. Thank you for watching. Let's meet in the next video as we look at the unlevered free cash flow schedule, as we fill everything from here to where there are those gray cells that we've not touched to. Thank you for watching. Hello viewers, welcome back. We are now looking at the unlevered free cash flow schedule and want to make sure that we have it completed. So let's jump in and go through a full explanation to make sure that we have everything built up correctly in our model. All right, so right into this cell here, in this cell K11, what we are going to do, we are going to put in an equal sign. After putting in an equal sign, we are going to tap the left arrow to grab the previous year's EBITDA. Use the previous arrow to grab the previous year's EBITDA. We multiply that by opening bracket 1 plus this estimate here of 7.5. So we use the up arrow to go up there, and then we can close the bracket. So that's how we've been able to complete the first formula, and now we can hit enter so that we can get that value right there of 19,757,000. Now let's go ahead and progress downwards. We are going to first wait to fill these ones of this side. Let's first focus on this column, maybe that column alone, until you go through the Excel sheet, until you finish this first part of the model. Now let's now go ahead and we are going to go into this cell. So we are going to finalize these sections up to this P11 a little bit later, but for now we want to calculate these values here in K11. We are just going to throw this cell first so that we can, that column first, so that we can have some of those numbers done. Then we can do a copy and fill it later on. Now what we are going to do, we are going to go into this cell K11, and we are going to calculate the operating profit. In other words, the operating profit in that cell K11 will be the EBITDA up here. So we put in the equal sign, we pick the EBITDA that we've just computed in K11 minus the tax depreciation, this one below cell. So it is this minus the tax depreciation. We use the up arrow to go to the tax depreciation in that cell K13 right there, and then we can go down, can hit enter from this, then we go down and we calculate the current tax. Of course, calculate the current taxes. So what we are going to do in this case is we are going to take the operating profit and multiply it by this tax rate estimate of 17.5. So it's going to be this value here. We multiply it by this one, the tax rate, the estimate of 17%. So we shall get, we hit enter, we get that current tax, and then we can go down here and calculate these other areas. So what we are going to do in this case is we are going to make sure that we progress downwards. So we want to move all the way down here where it says unlevered free cash flow. We want to make sure that we have also that in place. We finish the whole section here for unlevered free cash flow. So we want to put in all the figures in that section until we reach at this row 28. So we are going to end up using the sum function in this section here because we want to put in all these values here. But what we can do, we can maybe first connect these values. The EBITDA, you know where to pick it from. Because what we want to do here for this unlevered free cash flows, we just want to get the sum. We just put the sum function there because we know that the sum function is actually super quick. It has a keyboard shortcut that we shall show you how to use it. But there we put in the sum function to make sure that we get the unlevered free cash flows, the totals. But with that in mind, we are going to need to show the cash flows as positive. In other words, here, we need to show these cash flows as positive. The EBITDA, for EBITDA, in cell K24 is supposed to be a positive value. And these two line items for current tax here, and then the cash flow from working, those two items are negatives. So let's go ahead and start linking those values. So with the EBITDA in cell K25, so we put this in that K24. So it is just, this one is very straightforward. It is just a straight link. We will tap equal sign and then use the up arrow to move all the way up here to EBITDA. We move up to here to EBITDA, then we hit enter. We've now connected that. Now, what we want to do in these other cells for current, tax, we want to also connect those cells. In cell K25, they are going to be cash outflows. So we are going to put in equal sign negative because these ones are going to come as negative values. So we go to use the up arrow to connect these current taxes. So we come also, and so we've connected that. We need to connect now the cash flow from working. We need to connect, since we've connected the current tax in that cell K17, just like that, as we see over here for capital expenditure. We need also to connect this one for capital expenditure. Now, for this capital expenditure, as you can see over here, down here in this cell here, it says capital expenditure has been set equal to tax depreciation, meaning that note there says that the capital expenditure, they are the same as the tax expenditures. So we are just going to pull that figure for this. You've seen this capital expenditure we pulled, because we are going to pull this value here for capital expenditure. We are going to put in an equal sign. They are also going to come as a negative values because they are cash outflows. Capital expenditure and capital allowance, or the capex, it is this value there. So I've pulled that. We already have the cash flows from working capital. These ones are already there. So here we are just going to put in the sum function. So as we said, we are going to put in the sum function to have those in place. So we've connected those values, the tax depreciation, the capex was set as tax depreciation, so we have connected it to row 13, and we have also connected the current taxes to row 17. So we've done that perfectly. Now what we want to do is in this cell here, row 28, and want to put in a little sum function. So we go, because it's going to be EBITDA minus current tax minus this, then plus or minus this. If it was a positive, we would add it. But since it is already negative, we have to deduct it, the cash flow from working capital. So what we are going to do, we put in a sum function. So let's go through a manual way of doing this with the keyboard, because we want to go to using the keyboard first, and then we shall show you a little keyboard shortcut. So that shortcut that will help us to actually have the sum function in place really faster. So we have to put in equal sign. Here we are going to basically use the keyboard. So we put in the equal sign. Now what we are going to do, we go and type in sum, S-U-M. The moment you see it there, you hit the tab key, and you can see the sum has actually opened up the bracket. Now to get to the first cell, we can just tap the up arrow there. And now, because we want to highlight all those values, what we are going to do from this point, we are going to select all the way to the top. And the way we are going to do it is by holding the Control and Shift key all together, and then you tap the up arrow. It will determine where to end. The other option would be, let me just go back. If I go back to that, the other option would be you hold down the Shift key, then you use the up arrow to highlight like that. But the other one does it faster, because you just hold down Control and Shift, then use the up arrow. It will take you to the top, or it will highlight for you all the values. So that gets us to the end of that range of numbers. Normally, what we normally do after selecting the range, we always want to close the bracket, and then we hit enter. But one little tip, if you are only putting one set of bracket, like the way you are seeing there, we have only one set of bracket in Excel. You don't have to close the brackets. So we can just hit enter now. So you don't have to close the second bracket if you have just opened only one set of bracket. But if there are many, you make sure you close them off. So if you just hit enter without closing the bracket, Excel will close those brackets for you, just like the way we've done. So we built this manually just to show you the keystrokes, since you would need those keystrokes if you are doing a function other than sum, because there are other things that you are going to do, like average, like mean, median, mode. So those are the things that you will do when you are using those keystrokes. That's why we had to go through that manual way. But now we can go back to this cell K28, and we can now we can delete this. We can first undo this, Control Z. And now when we are in that very cell K28, where we want to put the sum function, you can just come here and hit a one shortcut that will take you to that point, Alt equals, and it has provided for us the sum function. So it puts in the sum function with open and close brackets. it correctly detects exactly where the numbers start and end. And then you can just hit enter and you have the same answer like we had before. So once again, Alt equals and then hit enter. It is super quick. Now, we purposely built just one column. You've seen we built only one column, that is the column that we only develop, column K. We did that on purpose because it can be really quick to copy across from left to right. It will be very easy for us to copy to this side here. It will be very easy for us. So we did that on purpose. That's why we took only one column. So let's get started on the process right now and we see how we can be able to copy and paste the formulas that we put in place. So we can start from that point, K11. Now, when people use the mouse to build financial model, they often click here. They click and drag things. For example, right here in this cell, K11, if you want to copy the EBITDA from left to right, what you would do, you would come here with your mouse, you grab this small plus symbol. When you see that small plus symbol, this one, as you can see from here, when that happens, what you do, you just hold it from there, then you start dragging to your right, and you can have that filled up. So they wait for that tiny plus sign and you drag across. Because if you try to drag across up to there, you'll have the answers. The answers are still correct. But now there are now two problems that we've just got with just using that. Because remember these were the borders. Number one of the problems, it is even slow because we have to find that mouse and aim certainly for the corner of that very cell for that plus symbol to appear. But the other problem, if you look closely here in this cell P11, that has, we have just copied everything across, and it effectively elasts the nice formatting that we had over in this column here for the terminal column. Remember this terminal column, the whole of this, we had some borders in here. It has deleted it. So what we do, we first undo that, Ctrl Z. These borders were already off, but we want our borders to be there. In other words, our little formattings, let them be available. Now what are we going to do? So let's now try to do things in a different way. So what we are going to do, instead of us doing a copy and paste, do a normal paste throughout, what we are going to do, we are going to copy that cell K11, do a normal copy, Ctrl C, and what we are going to do, we are going to hold down the shift key when we use the right arrows to highlight across. We've highlighted all the sections that we want. Now what we are going to do, we are going to use Ctrl Alt V, that is for paste special, which brings up that paste special dialog box. So what we are going to do, we are going to use the down arrow here to go to formulas, and then we can hit enter. You will see that we've gotten the same answers, but we have not deleted our nice formattings. meaning we only copied their formulas alone. So it is really nice. So what is really nice about this technique is that Excel has pasted only the formulas and it never pasted the formattings that we had in that cell, even though we had copied it. So it was able to preserve the nice little borders, these borders that we put in that terminal year. So let's try again and do the same thing for the next row for this operating profit. So we need to also fill in that section there. So we are going to do the same thing. We do a copy, Control C, then we use the Shift key to highlight across. You use Shift, you hold down the Shift key, then you use the right arrow to move across, to highlight across. And now what we are going to do, we are going to go to Control Alt V for paste special. Then we go down to formulas, use the down arrow to go down to formulas, you hit enter, and we've gotten that in place. Now, another way to get into that special, paste special, is to use Alt ES. That Alt ES brings up the same menu down to formulas, and then you hit enter. So let's try that out. We first copy this one, Control C, hold down the Shift key, use the right arrow to highlight across, then use Alt ES. It brings the same paste special function. Then we use the down arrow to go down to formulas, you hit enter, and we are done. That's perfect. So the shortcut is, it's either you are going to use the Alt ES, the shortcut is either you are going to use Alt plus ES, or you will use Control, you hold down Control plus Alt, then V. Both do what we call paste special. So that's what we wanted to discuss from that perspective. So we are going to do the same thing as we progress to the next sections. So we are going to progress downwards when we are doing the same thing. So we go to these other areas here. These ones, actually we can come and highlight them all at once. We could grab this bunch of cells and hold them. You can come here, you hold down the Shift key, you use the down arrow, you move up to that row 26, then you use the right arrow as you are still holding the Shift key to highlight across like that. Now what you are going to do, you are going to hit Alt ES, then you use the down arrow to go down to formulas, and then you hit enter. Sorry, we didn't copy. So we first hold down this, because what are we pasting? We didn't copy anything. So we hold down the Shift key, we highlight downwards there. Then we do a copy, Control C, and after that, then we highlight across. Shift, you hold down the Shift key, use the right arrow to highlight across, then Alt ES. You use the down arrow to go to formulas, you hit enter. We've put everything in place. That's what we call paste special. So for you to be able to highlight, we said you hold down the Shift key, and then you use the arrows, either down arrow or right arrow. So you can be able to highlight those values there. So we've done that, and we have those values in place. Now what we want to do, we have to go to this last one, K28. So we copy, we do Control C to copy, use the Shift key, hold down the Shift key, use the right arrow, Alt ES, use the down arrow to go to formulas, hit enter. We've done filling what we have done is we have completed the unlevered free cash flow, what has been shortened to be UFCF. So we are all now set for this page, and we can see in the next video that we are going to start on the next schedule, because we have done filling the first schedule. So this one, the discounted cash flow schedule, is the one that we are going to look at in the next video. Let's see you in the next video as we are looking at the discounted cash flow schedule, part 1. We see you there. Hello viewers, welcome back. We are now looking at the Dcf schedule. This one right here is the one that we are doing the computations for, and this is going to be our part 1. So let's move and look at what we can be able to do in here. So let's try to move back into and try to see on our unlevered free cash flow schedule. So let's try to move a little bit. This unlevered free cash flow. Let me first delete this. Back to our unlevered free cash flows. There. Now, here we can see in this row down here, in this cell K28, we have the unlevered free cash flows. And the next schedule down here, it starts with the unlevered free cash flows, meaning the figures we have up there are supposed to be linked up to that schedule. So let's get started and look at how we can be able to get down to our DCF model, sorry, the DCF schedule, and we'll see what we can do from there. One of the things that we are going to do, we are going to need the unlevered free cash flows in this DCF. You are seeing from this row 44, these sections here, they need those values for unlevered free cash flows. So we are going to repeat them in this row 44 so that we can make use of them with their formulas, and we see what we can do. So when it comes to time, and also when it comes to time to print this model, everyone can see on the DCF schedule the unlevered free cash flows. So these would be super easy to link up, because when someone sees a printed copy, they will need to know where are these values, where are they coming from that are feeding in the discounted cash flow schedule. So some of them we are picking them from the unlevered free cash flow. So we pick from K44. So we put in an equal sign here. They are coming as they are, because they are going to be inputs in this cell. So we go up to the unlevered free cash flow up here in cell K28. Then we hit enter. Now we've been able to have that figure linked up to that point. Now, one thing that we are going to look at is we are going to make sure that we copy and fill those values right. So what we are going to do, we do a copy, Ctrl+C, use the Shift key and the right arrow to highlight, Alt+ES to paste special, then you use the down arrow to go down formulas, and we have those values in place. Because we don't want to copy and paste, we shall remove these little borders here. So to avoid that, we just do a paste special. So now that we have those values linked up, we can move the cursor down to this section, and we try to bring this DCF model into focus. So we can try a little bit to move At least there we can be able to see some of the values, maybe to just like that, to have those values in place. Now, let's remember that we always want to think about our DCF valuation in two parts. Part 1 is the discrete forecast. Part 2 is the terminal value. That's what we did from the first perspectives, or from the first videos that we had from the first chapter. We say these cash flows, they are mainly two. We have the discrete cash flows, and at the same time we have the terminal value cash flows. So what we want to start off in this section here, this row 48, from this point here, what we want to start off with is want to make sure that we have those values in there. So we are going to be in this section, this row 48, in this section where it says discrete forecasts. Now, so we are simply just going to link these up. So we are going to get these values, the values that we are going to get in this cell K48. We are just going to go in there and we put in an equal sign. We are going to link those values from those unlevered free cash flows that we have there. So we go up to the unlevered free cash flows in that cell K44. So we move up using the up arrow, hit enter. So we've been able to transfer those values. Now what we have to do, we do a copy, Control C, we highlight across using the shift and the right arrow, then we do a paste special, Alt ES, down formulas, press enter. We've been able to take all these values from this point up to there, but we've left only one value here. So that value that we've left, you've seen the corresponding column is within the terminal. So that's what we are going to discuss next. Now, that has been done perfectly. Now what we are going to do, we are going to this second row, that is row 49, and we are going to this section where it says terminal value, and it's going to be in this area there. Now, terminal value here, this is the point where we want to stop and pause for a moment. We have a terminal forecast here. This is a terminal forecast of 17,670,000 US dollars for the unlevered free cash flows. So that value is in cell P44. So the value of roughly 17.6 million US dollars in cell P44 will repeat and grow forever. That is the terminal value. In other words, it's the one that we are going to use to calculate the terminal value. So it's going to grow at a rate of 2%. This value here is going to grow at a rate of 2%. This is the growth rate, terminal growth rate of 2% in cell G49. And it's going to be indefinitely into the future. So what we are going to do is we are going to use the growing perpetuity formula, and we are going to go and put that formula right in this cell here, this cell O49. So we put in an equal sign. Remember, for the growing perpetuity formula, the formula is the perpetuity formula. The formula is the terminal perpetuity formula is cash flow over the discount rate, which is R minus G. G is the growth rate, or the terminal growth rate. So that's the formula that we are going to use. So this is the terminal cash flow, or the terminal forecast, this one. So that's the formula that we are going to insert in place there. So what we are going to do now, we pick the cash flow. The cash flow is this line that you are seeing here. So we are going to grab the numerator as the cash flow of roughly 17.6 million US dollars from this point here. And we are going to divide. We divide that by, we open brackets. It's going to be our R, which is the discount rate, all the work. So after opening the bracket, now we are going to the denominator, and we are going to have the R, which is our work, in G50. This is the work, minus, we are going to less off the growth rate. That is our G, which is the terminal growth rate, which is in G49 here. So we can close the bracket, and now we hit enter. So we've gotten that value, 454,000 US dollars. So next up here, for this column here, row 50, from this point where it says total cash flows. So what we are going to do, we are going to use our favorite new shortcut, the alt equals, and that puts in the sum function. So we go alt equals. We can now hit enter, and we can see it has put in the sum function. So what we do a copy, Control C, highlight across using, we hold down the shift key, use the right arrow, then we go to alt ES, paste formulas, and then we can hit enter, and we are done. We are done with that section. So for the next step, we want to progress to this row here. Let me just add just a little bit. This row 56, to this section where it says present value of discrete. That's the point where we are heading. And you can see we are going to figure out the present value, or the PV, of the discrete forecasts, and the present value of the terminal value in the next section here, this one right here. So this is where we are going to figure out those values. But now we are only going to use the NPV function to have that in place. So we put in an equal sign, we say NPV. The moment you see that NPV comes up, you hit the tab key. It will open the bracket. Now, one thing it is asking for, it is asking for a rate. So in that cell F56, we've put in NP function, and it has opened the bracket. So you can see right here, it is looking for the rate, and the rate is going to be our work, and work is within the cell G50. So we can use the up arrow, we go to G50, that is the G50, and we've picked that value there. So we put in a comma, and now what is asking for, it is asking for values. It is looking for values. So for the values, you don't need to select these values individually. You can just go up to this row for discrete cells, because these are the discrete values that we want, the whole of these. So what we can do, we can actually go to that section. So we can go and select all those discrete values at once, and then we close the bracket. So we can go use the up arrow to move all the way to this section. We start from that point. It is K48. So we use the shift key. You can use Control Shift, then right arrow to highlight all of them, or you can use you hold down the shift key, you use the right arrow to move, just to select those values like that. And then we can close the bracket, shift, or close the bracket, you hit enter. And you've seen we have those values right there. We've gotten the present value. for that. So we do the same thing for the PV of the terminal. And the PV, the formula for PV of present value of terminal value will be almost identical. In other words, it will be almost the same, like the one we've just done for discrete values. So we put in an equal sign, put in NPV, we hit the tab key, and then we are going to grab this rate here. We are still using the same rate, that is our work. We put in a comma, and then we are going to select the values. We are going to base for these values in this row 49 here. These values where it says terminal values, we pick all these values here. We can start from this point right there. Then we don't need to select one figure by one figure. We can just use the shift key, hold down the shift key, right arrow, highlight all the way to that point. Then we can close, shift O to close the bracket. So since we have highlighted those values, now we can hit enter. So for the enterprise value, just to finish up here, for the enterprise value in cell F58, we are just going to put in the sum function. We can just use Alt equals to have that in place. Hit enter, and we've gotten that value already, 133,793,000. So it is 133,793. So those are the values that we have there. So we have now gotten those values there. Now what we want to get from this point here, these cells, these remaining cells here, those ones, we just need to have percentages there. What is the percentage of the discrete over the total, and what is the percentage of the terminal over the total? That's what we are going to get. We just get the percentages. So over here in this next cell, this G56 can come to this one. We put in an equal sign, that G56, and what we are going to do, we are going to put in the PV, this value right there. We divide by the total, that is the enterprise value. So we divide by this cell F58, this one. But now that F58 is supposed to be locked with dollar signs. So you can just hit F4 key just to have those in place. If your F4 key is not working, you come and manually put in those dollar signs. You use the shift 4 to put in a dollar sign, and even here, $2 signs to have that locked. In other words, we are locking the column F and row 58. So we hit enter. That has given us 39. So we can copy across so that we can have those values in place. So what we are going to do is we are going to copy this one, Control C, highlight downwards using shift down arrow, then Alt ES, down to formulas, using the down arrow to go to formulas, hit enter. So we've done. That's why you are seeing this one is 100%, because it is 58 over 58, which gives us 100%. So you can see from here up here that we have that F58 being locked with those dollar signs. So now, so that F4 key, if at all it has worked, it is the one that helped us to lock those cell references down there. So those small shortcuts, they help us to save a lot of time, and at the end of the day, and at the end of the week, we find ourselves saving time. So what we are going to look at now, let's go to the next video, and we are going to look at how we can be able to get the rest of these other values. So let's go to the next part 2 of this video, and we'll look at finishing this section right here. So we'll see you in the next video. Hello viewers, welcome back. We are now looking at the DCF schedule part 2, and we want to finalize these sections here that we haven't touched on. We want to look at these sections right here. We'll finish these sections and also look at one last point that we didn't talk about up here. These dates. This one for dates, we didn't talk about it. So we need also to finalize those two sections. So that's what we are going to focus on for now. So let's try to scroll down and have that into focus. Let's first finish these three sheets that we have here, the tables. So let's continue down this process, and you can see here we are just repeating the enterprise value from this point here. You are seeing we are just repeating that value for enterprise value. So what we need to do, we need to link up this value here. So we go equal sign into that cell here that has that value here, F58. So hit enter, we have linked that value there. So now what we are going to do, the enterprise value that G63 has been computed. Now we can go, we are going to use that enterprise value that we've computed in cell G63. As you can see, we want to subtract the enterprise value, you want to less off the net debt. So what we are going to do here, we are going to just use the sum function because this one is already in bracket. So we use the sum function to have that subtracted. Alt equals, and we hit enter. We've now been able to get our equity value in that cell G65. So we can see we've subtracted the net debt, and that's going to give us the equity value. And that means here we have to just connect up things. If you go to this cell here, cell N56, if we progress to that point there, cell N56, we are seeing that we are repeating the equity value that we have already computed. So what we are going to just do, we are just going to make the model clear and nice by just linking up some of those values. So what we are going to do, we put in an equal sign there, and we move all the way down to this section here in cell G65 to have that in place. So we have linked it to that side. So now what you see down here, this section is for equity value per share. So meaning this one is supposed to be equity value per share. These are shares outstanding, roughly 34.2 million US dollars. They are shares outstanding, number of shares outstanding. So the equity values that we are seeing in cell N56 are the normal amounts, the nominal amounts of about 115 million. That is in equity value. But we know how many shares are outstanding here. 34.2 million shares. So now what we are going to do, we are going to figure out the equity value per share in US dollars here. So what we are going to do, we are just going to divide the equity value by the shares outstanding, and that will give us the equity value per share. So we put in an equal sign here. We get this value, we use the up arrow, that divided by number of shares outstanding there. Hit enter, and that will give us the shares, number of shares, the equity value per share which is $3.37 per share. Now, the nice thing about this kind of analysis is we essentially come up with our own view of the value of the business. In other words, the value of the shares. We come up with our own view. In other words, we do our analysis and we come up with our own view of our shares. Now, the issue here is that since we've computed our own view, we need to find out what is in the views of the market. In other words, we tap into the market and we see what is the current price in the market. In other words, we look at the market's view. And the market's view is right down here in this cell N64, where it shows $2.71 per share. So this means that we've actually gotten a higher value than what it is in the market. So what we are going to do, we are going to link up, because this one for premium, it says here equity value per share. So we need to link up this value in cell N63. So in order for us to do the comparison, we are going to calculate if our view is at a premium or it is at a discount to the market's view. The only way we can do that is by picking the equity value, our view that we've computed, which is in this cell here. So we link it up to this point in cell N58. So we get it down here. So we compare these two values, this one and this one. Are we at a discount or we are at a premium? In other words, we are seeing that 3.37 cents and 2.71 cents, we are seeing that our view is higher. So what we are seeing here is that we are now at a premium because our value is high. Now we want to compute we want to compute that premium, but we want to compute it in a percentage, because if you just get the difference, that will not give us what we want. We just need in a percentage. What is the percentage of that we've made as a premium? So what we are going to do, in order to finish this up, we are going to put in an equal sign here, and we are going to take our view of this in cell N63. We divide it by the market's view. So that is this divided by the market's view of that. And now we are going to less 1 minus 1, because we need a percentage. We want to have those values as a percentage. So minus 1, and then we hit enter, and that is going to give us 24.2%. So our assessment of the value is at a 24.2% premium to the market's assessment of the value. And this is one of the things that we are always looking for when we are doing this type of analysis. In other words, are these going to be opportunities where our view is different from that of the market's view? And if it is so, that creates an opportunity, because now if we are to go and purchase the shares or the stock at this place, and then we are now correct about our view, because now you may go and buy at $2.71, and you find that our view is now correct, meaning we shall stand a chance to make a nice return of 24.2%. So as you see, we are not yet done with this analysis, as you can see from this point, because there is one item that we haven't discussed about. This is the item here in this section here. That's the one that we are in for this row 40, where it says valuation. So we start from the discrete and all that. So what we need in here, we need these dates to do is to increase forward by 1 year at a time. In other words, we want these values to be increasing. We are also going to use a formula to have that in place. And the easiest way to do that is by using an edit function in Excel. So what we are going to do, we go into this cell, L40, we put an equal sign, we go to edit. When you see edit comes up, you just hit the tab key and it has opened up. Now what you are seeing here, it says start date. Now, for the start date, we can see that the start date is this one right here, because they have already given us 23rd, this one. The year is 2023. Actually, it is December 31st, December 2023. That is our start date. The valuation date is 1st Jan 2023. So what we are going to do, we can use the left arrow to just pick that start date at K40, in that cell K40. So we put in a comma. And now what it is asking us, it is asking us for the months. Now here we shall put in 12, because the year has 12 months. And then we can close the bracket. And when you do that, you come and hit enter. And it has changed this one. This one is now at 31st December 2024. So it has put in the date that we want. The only thing that we need to do to complete this is by doing a copy, Ctrl+C to copy. Then we use the Shift key to highlight across, using the right arrow to highlight. You hold down the Shift key, then you go the right arrow. Then we are going to paste special, Alt-ES. Now, we want now to paste the formulas, because they are the ones we put. We paste the formulas. Now you are seeing the value has been changed. This is 2025, 2026, 2027, 2028. So those are the values that we wanted to have in that place. So now that we've finished that, we can see that we have completed the Dcf schedule. Now what we want to do in the next video, we are going to move down to this section right here, for sensitivity analysis. And that sensitivity analysis page is where we are going to show some really neat technology that we are going to use to fill in all these tables, because here we are only seeing what is here. They are just tables. This table, this one, and this one, there are 4 tables. So want to look at some neat technology or some terminologies, or the techniques that we are going to use to fill these tables. So what we are going to do from this section is we are going to use what we call the data tables. So we'll see you in the next video as we are looking at sensitivity analysis. Hello viewers, welcome back. We are now looking at sensitivity analysis, and this is our part 1. So let's move back into the module and finish up this last schedule. All right. If we look down below, we can see its sensitivity analysis schedule. And what you want to do is position this screen right here, because we have a bunch of values in these boxes that we are repeating in the sensitivity analysis page. In other words, these sum of values you are seeing in this section here, there are some values that we are repeating, and we are going to use them under these sensitivity analysis tables. So we are picking these values from the previous section, that was the DCF model schedule, and now we want those values to be fed into that section there. So since we know we are going to need some of those information, so that the formulas down there can easily link to these values. The things that we are going to do in these tables, they are actually going to be linked to some of these, or these are going to be inputs, whereby we shall apply the inputs on these values so that we can be able to get the values in these tables. So what we have to do here is relatively straightforward, just linking a bunch of these cells up. Like for the terminal growth rate, we are going to link it to link that here to 2%. Weighted average cost of capital, we link it here at 13.5%, and the enterprise value, we can also get it from there. So some of these values that we have here, we are going to just link them up. These are values that we can actually obtain from this side. So let's try maybe let's start with this one, the enterprise value. We put in an equal sign, we pick it just it is close here. We use the up arrow to move down to this point, G63, and we've gotten that already. The net debt, of course, we also have it there. So we have the values. Now for net debt, we want this to come out as a positive number. So we are going to put in an equal sign here for net debt, and that was G82. We put in an equal sign negative, because we want to pull that figure as a positive number. So we are going to move, and we pick it from G64 here. Then we hit enter. Now, so we can also pick these values here. Remember, these are hard codes, these blue ones. We can pick them and connect them here. Or we can go and look for where there are those terminal values from up here, and we link them up maybe from this point. These ones here for the assumptions. So you can come here, put in an equal sign, we can pick it from here. Let's pick this 2% from that, and we also put in an equal sign in work. We move up and we pick it from that point. So we've gotten the values that we are going to use. We have also shares outstanding. We can also pick it up, equal sign. We pick it up from cell N57. We can also go to the last one, that is the current price. The current price is also here. We pick it up from this point here. This is the current price, $2.71. So we've finished getting those values from those different sections that we have. Now let's bring these cells into focus, because we want to look at these items. So let's try to adjust them just like that, just to have those visible so that we can easily see what we are building, and we'll just find the values that are missing within those different tables. Now, the reason that we put a lot of these values up here in this area, the reason we are putting these values up in this area, starting from this, the reason we are putting all these values here, let me just highlight them. The reason as why we are putting some of these values up on top here, as you've seen, those values that we have in the upper section, because those values are belonging to the previous schedule or the previous section. So the reason why we have or we repeat those there is because we know that we are going to need them in the schedule. We repeat them here generally for two reasons. Number one, so that we can easily link formulas to them. But number two, when it comes to time to print the schedule, everyone that is looking at the schedule can see exactly the values that we are feeding into these sensitivity tables. One of the first things that we could do that would be relatively straightforward is to get all of these values here from the terminal growth rate. So what we could do, we could just look for these values all the way from this section here. Let's have that in focus. So what we do from this point here, from that section for terminal value, the whole of these values here, like we highlight, shift right arrow, the whole of those values for the terminal values and for the weighted average cost, these values you're seeing. In other words, these ones for work, those that are moving on the y-axis in that column C. We put all those values repeatedly. In other words, they are going to be repeated for all the different tables, so that all the four of these tables, all of them are completed and ready to go. Because you are seeing we are putting these values even here, they are the same values that we have on this section here for table 2, even for this y-axis. So we all have work, even here work, and here is terminal growth rate, and even here terminal growth rate. So the reason we are putting those values there is because we want these values to be completed at once. So what we can do is really straightforward, because we want to just link, we are going to just link these cells here. Like for cell, this one, for this cell C101, we make sure that we have that value, this value that you are seeing up here, 11.5. So we are going to just link those values up there. This one 102, this value that is in here is the very value that's supposed to be on this section. So we put in an equal sign, we link it up from this point here, C90. We've gotten that. We also do the same for the terminal value. Or we can first finish this one, we highlight downwards, shift down arrow. Then what we are going to do here now, we can, because we don't have any formatting that we are going to disorganize, we can go Control D. Control D is a fill down. Remember, we used of having Control R, meaning for a fill right, but this time around we are taking a fill down. That's why we are taking Control D. Even this one we can put in an equal sign, we pick the value from this point in cell D89. So we've gotten also that working, and now what we can do, so this terminal growth rate for D101, we've connected it to the terminal growth rate from this point. So we can also do a few right from that point, because this is going in a horizontal way. What we have to do, we hold down the shift key, use the right arrow to highlight across, then Control R for fill right. And we've been able to get all these values. The same way is the same way we are going to do for these other tables, for all the 4 tables. So we get this one, we connect it to that. We get this one, we connect it to this one. Same values. Even here we do the same thing. Connect it to that. Even here we do the same thing. So you've seen we've tried to connect those things up. So we need to do a fill right and a fill down to make sure that we have all those values in there. So we do start from this shift down arrow, then we do Control D for fill right. For this, shift right arrow, then Control R for fill right. This one, shift down arrow, Control D for fill down. Then for this, it is shift right arrow to highlight across, then Control R for fill right. So that is perfectly done. We have been able to put those values, the terminal values and the work for the different data tables that we have in place. Now, one thing that we are going to look at now, one more thing that is remaining for these other tables is that for the first table, we are going to make sure that we use data tables to have this table filled up, this inside part of it. We need to fill it using data tables. Then these other ones, we can fill them based on the information we've gotten from this first table. So that's basically what we are going to do. Now, earlier on we mentioned the idea of using the mouse, where users, they grab the cells and drag them to anywhere they want to have those values. Well, when we are dragging, it's the equivalent of filling right or fill down. Maybe let's just take a quick look at how we can be able to do this. We will quickly erase some of these videos. Maybe we try to remove these ones. From this point up to this, we can delete those. We highlight them, then we hit the delete key. So we want to do that copying of dragging with the mouse. Now, what we are using the mouse. We've been using the keyboard to fill in those values. But now if you are using the mouse and we are trying to grab these values and we copy and paste them to different sections, all the different cells that we have there. Now, when you use the mouse, you just come down to this point here. Let's say on this cell K101, you just come to this small. When you see that plus sign there, then you can drag through like this until you get everything filled up. Even here, you grab, and what you are doing here is what we call a fill down. What we've just done on this side is a fill right. So that's the equivalence as maybe you're using for, you're picking up the mouse to actually have those copied in there. So we've just find it much easier and fun to do those different values using the keyboard, and it's really faster. So what we've just done, we've made sure that we've put in all the terminal growth rate, and at the same time we've put in the work percentages as they were given to us. So now what we are going to do, we are going to look at the next video where we are going to start filling in the things that are within the insider section. In other words, our focus for now is going to be on this first table, the whole of this one. We are going to be focusing on this table right here. Then when we are done with this, it is what we shall use to make sure that we have this one and this one and this one filled up. They are all going to base on this. But on this first table, we are going to use data tables. Then the rest we will pick the information from this first table. So we'll see you in the next video as we are concluding with those remaining sections. We'll see you there. Hello viewers, welcome back. We are now looking at sensitivity analysis part 2. So what we want to do now, first of all, connect this first table right here for the enterprise value. This first table here for the enterprise value. Now, we want to connect that first table for enterprise value, and we make sure that we have these other values gotten from that same value. So we want to get all these other three from what? From that column. In other words, what we are looking at is we are looking at a situation of getting these values, these tables here, these ones, and this one. They are all supposed to be gotten from connecting these values here. So we need to first work on this first table. And after working on it, then the values that we have, they are the ones we shall use to put in that, putting in some in that table, and also filling that table. So we need to see how are we going to be able to have that in place. So let's go ahead and look at how we can be able to have those in place. Now, the way that we are going to do this is we are going to use what we call data table functionality. In order to get this working, if you haven't used the data tables before, I think you are going to be quite impressed with how these data tables work. It's really powerful tool inside of Excel because it gets things done very fast. First thing we need to do to get the data table working is we need to think about what exactly is going to be inside this first table. What is going to be inside this table here? That's the first thing for us to think about. What is it that we want to be in that first table? Inside that first table. Well, inside this table, we are going to show the enterprise value. So in here, we are going to be showing values for enterprise value. Inside there, we are going to be showing enterprise value. You can call it EV, enterprise value. We are going to have those values under a bunch of different circumstances where we are changing the growth rates. We are going to be changing these terminal growth rates and at the same time changing the weighted average cost of capital. That's work. So we are going to have different EVs or enterprise values that are going to be in relation to these changing values on the vertical axis and on this side of the horizontal side. So the values that we are going to be having inside these cells, they are going to be, first of all, having one terminal value, sorry, the terminal growth, and at the same time they have a work. So those are the things that we are going to look at. In other words, these enterprise values that are going to be inside this cell, they are going to be varying with the different weighted average cost of capital and the terminal growth rate. So since we are going to show enterprise values inside this first table here, what we are going to do, then we need to link the enterprise value in this corner right here. This corner here is where we are supposed to put our enterprise value, because that's the corner of cell, it is cell C89 that is highlighted in gray. It's the one that is going to be the meeting point for those two values. So that's where we put the value. So let's see what we can do. But let's firstly move this. Now we are going to go into this cell. We put there the enterprise value. That's where we are going to put our enterprise value. That's cell C89. So let's get started and see how to do things here. So the first step is really simple. We are just going to put in an equal sign in this cell C89. Then we pick that value up there for enterprise value in this cell right here. Let's move. This is where our enterprise value is, in this cell G81. So we put in that value there. So we can see the enterprise value is right in this cell here. Now, next thing, what we are going to do is select the entire table. So we select the entire table, but we are not just going to select this inside area here. We are not only going to select this area here, the inside part alone. No. We are going to select the entire table. And we have to make sure that we include this very item that we've just put of that cell C89. So that's the enterprise value, where the enterprise value is. And at the same time, we have to highlight these terminal values, and at the same time we highlight these values that are both on the y and the x-axis. So we are going to start moving from this point, from cell G81. Sorry, from cell C89. That's where our enterprise value is. We are going to highlight when we are going horizontally on the axis. Hold down the shift key, then use the right arrow to highlight, going from C89 then up to H89. And then we are going to move downwards, C89 up to this one of 94. There. So we've highlighted the whole table. So now that we have selected that area, we are going to need to activate what we call data table function. So we are going to tap Alt key, it will take us to the menu section. And now we are going up here into the data section here for A. So we hit A for data section, A for data section, and now we are going to go all the way across over here to the forecast section this side. This is the forecast section within the data section of the ribbon. In other words, the forecast tab of the data section of the ribbon. So we are going to go to this W right here for what if analysis. So we can see the W for what if analysis. So what we are going to do, we tap W for a what if analysis. Now, finally, you can see right down on the bottom here, we have data table. So we are going to tap T for data tables. And now, this little dialog box right up here, it has come up for us. Now, the computer is looking for two things: the row input cell and the column input cell. It's really easy to get these two mixed up. For the row input cell, the computer is really looking to know where it can go to change the terminal growth rate. And for the column input cell, it asks or it wants to know where to go to change the work rates. Now, for the row input cell, our instincts probably is to select the terminal growth rate that is over here, because this is where we've gotten the value that these values that we have here. You may find that our instincts are going to be landing on changing the values here for the terminal growth rate of 2% in that cell G79. But the problem is that this particular cell G79 is not driving the model above. In other words, this value that you are seeing here, it is only driving the models that we are in. But we want something that is going to drive the model above, that is the DCF schedule. So we are going to find the actual cells which drive the model above in the next schedule. In other words, we've picked these values. Where we've picked these values is where we are going to pick those two values, because it will be those cells that will be driving the model, this very model. Because when the other one changes, even these ones are going to change automatically, because these are just links. We've just connected them. So the point here is that we have to look for those actual cells which drive the model above in the next schedule. So what we can select for now, especially for the row input cell, we can go up here. Let's try to use the mouse and we try to move up here in this previous section that we were in, and we are going to pick these cells here. So we are going to go to these assumptions, because these are the assumptions that may change. That's why you're seeing these are hard codes. They are the ones, if they change, even the model down below will change. So it means these ones, they are the ones driving the schedule, the next schedule that we are working on. So what we are going to go is we are going to pick this value here for terminal value, that is G49. That's what we are going to pick for the row input cell. Just like the way the word is suggests, input, it's supposed to be an input. It's not supposed to be a value or a formula value. And then we can now go and hit the tab key, because we want to move to the column input cell. Now, for the column input cell, remember these terminal growth, they are the ones on the horizontal axis. The ones that are on vertical axis, they are the ones we call column input cells. So hopefully you can be able to get to those same ideas. It's also going to be this very number here, give 50, which is the column input cell, because it's the one that is on the horizontal and it is an input. So if we change that, even the model below will actually change. So that's why we are picking only the assumptions, because those assumptions, they come as hard code figures. So what we are going to do, we can now come and hit enter. From there, you will see that as if we've done nothing, because nothing you are seeing on the screen they are changing. But let's go down to where our tables are, and you will actually be able to see what happened. So let's go down to our table. Now, as you can see from our table here, everything is now filled up. It has been filled out. So you can see all the different enterprise values depending on the terminal growth rate and the work inside that first table. So it is inside this first table for enterprise value. So we have everything in here being filled up. As you can see, all those values are now filled up, which is a faster way for us to get those values in by just using data tables. Now, it's possible that the values inside that cell or inside that table for enterprise value, it is possible that those values, they may not actually match. They may not match what you see on your video right now. Because if at all you've done, you were following us and you were going through doing the same thing like the way we are doing them, you were supposed to be at this point where we are now. If you downloaded the template early and you started doing these computations, the challenge is that you may find that the values you are seeing on your video here right now as you are watching, they may be different to what you have in your Excel sheet. So that will be a problem, but it wouldn't be your own problem. It is actually, the problem is with your Excel settings, because we went through the Excel settings in our first course. So you can go back and recheck what we discussed on Excel settings, but it may be from that point. So, and that could be because there are some Excel settings, all settings within Excel, that we need to investigate. Maybe let's try to take a look and see what could be the problem, if at all you don't have the same values as you are seeing there. No. Now, we can also get into these settings from our menu without us using the mouse. We can actually just get into our menu, and now we use the keyboard to make sure that we go to that side of the Excel settings. So like we did before, we can go and tap Alt key. Now you can see up here on your left here, top left here, we have F for file. So we can now go all the way and tap F for file. Now, it's going to take us to that backstage view. So from this point, we are now going to pick the values from, we are now going to tap, because from the bottom here, you are seeing more. Meaning if you click there, there are very many things that are going to open up. So you can tap T for more options. And now T is taking you to those options that we have there. Now from here, you can use the tab key you can use the tab key, because we've seen this dialog box, it has come up for us to actually navigate through. So now what we can do in this dialog box, we can use the down arrow to move to get into this formula section here. Now, if you are in this formula section and what you want to see here is that you are set to automatic from this first point here, from this first one, calculation options, you have to make sure that you are in automatic. If you were set here down to this second one, this one automatic except for data tables, on that second one, then your data tables would not be updating by default. And if you are in that last option here, manual mode, then you would need to hit F9. You have to hit Alt Tab F9 in order to have those things recalculated for you for the data tables. So let's make sure that we are all on automatic workbook calculations, automatic. Then we can now hit enter. So now, if you've made that adjustment in that Excel settings, now that you've finished and you came back to the data tables that we have there, and you check some of these values, what we have in here and what you still have on your screen or from your laptop of what you've been doing, and you check that same table and you see maybe some of these values are not matching, then it may be that there is something also we need to check out. But for now, since we have made changes to the Excel settings, and now we are back in the data tables, let's try to do some check of some of these values to make sure that we have everything correctly. So we can try maybe to look at this small value. This one is the smallest here. 108 is the smallest in cell D94. So we want to see whether those values here in this D94 match the largest up here, because the largest is in this cell H90. We want to see whether those are actually matching. Now, if they don't match, then it means there is also something else that we might want to investigate. If your numbers are not matching with what we have, because this is how it's supposed to be, the smallest has to be on this side and the largest is supposed to be on this side. If that's not the case, then just know there is a problem. Secondly, if you see that even the numbers themselves in here, maybe this, if you try to investigate the numbers and you see they are not the same, like the ones you are having right now, then you just know there's also something that we need also to do an investigation about. So if they don't match, then we can try to do some investigation somewhere. Now, other things you can check is you can check these values. Maybe you can check these values. The value here, F, maybe let's go by F. These values, we can also check these values. The 2%, in here, this one, for the growth, the terminal growth. That terminal growth as you see, it is in blue, meaning it is in a blue font. It should be a hard-coded figure in there. So you can just put in, maybe you hit 2, you tap T, then enter. Those are not supposed to be hard codes. And even the value here for weighted average cost of capital, they are supposed to be also a hard code, 13.5. It's supposed to be, it's not supposed to be linked up. So we don't want the work that is right up here in this cell C92 and the terminal growth rate in F89 to be linked up. So if you have those two cells, as hard-coded figures, this one of 2.0%, the 2%, and the 13.5% for terminal growth rate and the work respectively. And you find that even some of these values are not actually matching, just know you've done a mistake. But if you have those values, they are hard codes, then you are good to go. So what we have to do now, we have now to move to the next video, and we'll look at how we can be able to fill these other remaining parts. Because now here, we still have this value here. There is a lot that we can talk about in this value, because this value here is the same as the value you are seeing in the middle here. So we are going to talk about those values in the next video as we progress to these other tables, as you can see, because we said that first table is the one that is going to give us the information that we shall feed in these other sections. So the rest of the tables are now going to be quickly completed because we have done what was hard. So we'll see you in the next video as we are looking at those remaining sections. Thank you for watching. Those are the values that are going to be inside that shaded part. Now, fellow viewers, welcome back. We are now looking at sensitivity analysis part 3. And one of the other things that you can do to make this look complete is that you can make this cell right here, this cell C89, essentially invisible by turning it into white font. In other words, we change it to white. Instead of being in black, we change it to white. So we need this cell C89 to be here for the data table to work. But the evidence does not, sorry, the audience doesn't really need to see that same section, because at the end of the day, what is reflecting in this area is what is in the center there. So what we need to do is that we need to change that cell 89 to white font. So let's select that cell. It is cell C89. We come here, we tap Alt key, H for home, because we know font colors are in the home section of the ribbon. Then from there, we want to go to this side where it says, we want to go here to FC for font color. This one, FC for font color. And now we'll be able to see that color palette. And then we can see on top here, we have that cell right there. So we can hit enter after selecting that white. So that's what we wanted to have in place to make sure that that one is invisible, because the audience, they don't actually need to see it. But those who prepared it, they actually know There are some values there. So once we remove those gray shadings, so we can see that we are able not to see anything there. So we can also change even the fill color. Alt H for home, then we go to H again for fill color. Then we can also select this white here. You will see that it has completely disappeared. Now we can see as if there is nothing that is there after removing that gray shading. So we only need to have this first table for the enterprise value table, this one alone. When we have that table in place, we are going to, because we only want that table to be a data table, and we are going to derive the other three tables from that one data table that we've created. So let's get started and see what we can do. So to get the equity value, because down here we are going like this, because there is no way we can connect here before getting the equity value, because from enterprise value you can be able to get the equity value. So to get the equity value, let's just bring that into focus. So for us to get the equity value, let's say in this cell D102, that one there, what we need to do for this table, we know that equity value is going to be equal to enterprise value minus the net debt. So we have the equity value, which is within this cell. The equity value that we are talking about is this one. Let's bring this into focus because we need to be seeing both tables. I think there it's fine. So the cell D102, we are going to pick the enterprise value from this. That is D90. Those are the things that we are going to pick. Now, what we are going to do to have those values in place, we are going to have an equal sign here, equal sign. We move to D90 minus. Now we are going to less the net debt. And the net debt is up here in cell, this cell right up here. Let's try to look at the net debt. It's here in cell G82. So we can pick that figure there. But now, this figure G, or that cell G82, we need to put in the dollar sign so that we can lock that value in place, because we are going to do a fill right to have those values in. So what we have to do is to make sure, because all these values, they are going to have this one minus this one, 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 meaning this figure is going to be fixed in one place. We are going to lock it, because all those values within this table, they are going to be subtracted from this. In other words, we are going to subtract this from all these values that are within these tables to get the values for these filled up. And the only way we can do that is by putting the dollar sign. We make that column, so that cell fixed or locked. That is what we call the cell referencing. We can tap the F4 key to have that locked. But if it's not working, then we can manually input those dollar sign. You lock the row. The row is 82, so shift 4 to put in the dollar sign. Then you lock even the column G, shift 4 to put in the dollar sign. Now we are done. We've put in those dollar signs in that cell. In other words, we are locking the G column and at the same time locking the row 82. So now we can hit enter. When we hit enter, even if we don't do anything else, we just copy and paste. So what we are going to do, remember this is a table. Now what we are going to do, we are going to copy this value in that cell D102. Control C to copy. Then we are going to highlight. We use the shift key, we hold down the shift key, we use the right arrow to highlight across, then the down arrow to highlight downwards. Now we've highlighted everything. Now what we are going to do, we are going to make sure that we do a paste special. Alt ES. What are we pasting? We are pasting formulas. So we use the down arrow to go to formulas, and then we hit enter. And we have that figure filled up. Very easy. But now, here is a little tip, Excel tip. Just if that copy and paste worked correctly, just to make sure that that copy and paste, it has actually worked correctly. If we go into this cell, this first cell, in here, that D102, and tap F2 to be within that cell, you'll find that we have cell referenced the G82. So we can see that that one is correct. Now, all we have to do is to make sure that we do the same auditing. We move diagonally. We move like this. In other words, we move, remember diagonal lines, they are the ones if, let me just show you something. If you are to move diagonally, it means from this point where our cursor is, we are going to move up to this point, this one. If the cursor was here, we would move up to this point here. That's the diagonal movement. Because if you check this point and you also check this point and they are all okay, it means all the data table is actually fine. So that's the kind of auditing that we wanted to carry out, to make sure that what we have done here is actually the copy and paste, it has actually worked right. So we go to this one. You will see that even these ones are actually, so it is this minus this G80. So you hit enter. So it means we have done the right thing. So the issue for auditing is actually what we did in our previous lessons. So you'll be able to go through our videos and you'll be able to understand some of those things, because we need to be able to save time, but at the end of the day, we are doing the right thing. So we've done the auditing and we found that those dollar signs are actually existing all the way across. So what we want to do is we want now to move to the next area. Now, what we want to do, we want to move from the equity value, and now we move back to the third item here, equity value per share, and we want to fill in those values there. We know that equity value per share is actually the share value divided by the number of outstanding shares. So next up in this cell K90 is our equity value per share. And this is very straightforward and very simple as compared to what we've been doing. So what we are going to take, we are going to our equity value. This cell D102, this one here. So we put in an equal sign, we go to this one. And now what we are going to do, we are going to divide that we divide that value with, now we are going to take a look at the number of shares outstanding. So we look at the number of shares outstanding. They are this side up. We brought them up here. So let's check the number of shares outstanding. They are here in cell N79. But now we have also to tap the F4 key to have that locked in one place, because all these values here for equity values, the values that are going to be filled up here, they are going to be based on this same number. So we have to make sure that we put in some $sign, shift 4, and even come here, we put in shift 4. The other shortcut is to hit the F4 key. We press enter, then we can be able to have that value displayed in that cell K90. So what we want to do now, we want to copy that cell K90. So we do a copy, Control C. And now what we are going to do, we are going to highlight across. So we hold down the shift key, right arrow, then we hold down the shift key again, down arrow, to highlight like that. So we've highlighted those values, and now we are going to do a paste special. So we go Alt ES. Then we use the down arrow to move down to formulas. We hit enter, and we are finding that we've filled all those values in there. So we filled all those values in that cell. So even if you try to do an audit, you'll find maybe from this cell, you find that this one is cell referenced to this value here. So which is right. So we can now see that we have all those values filled up. Now, the other thing that we want to look at is we want to make sure that at least we look at the last table, we complete the last table. So let's scroll down a little bit to this way so that we bring this into focus, because we want also to be seeing even this one, because we are going to use information from that. So let's now start from that K102. We need to find information that we are going to use for that K102. So this one for K102 is for premium or discount to current price. Remember, the current price is up there. Now, this is also a very similar approach like the one we've gone through, and we are going to use this formula in cell K90, this one here. That's the values that we are going to use. Remember, here we are just doing a comparison to find out whether we have a discount or we have a premium. So we are going to pick that value from here. So to get this value, we shall get equal sign. We are getting the hour view, we divide by the current market view. In other words, these are our views. So it is going to be this. So we use the up arrow to pick this value up here. It is that divide by. Now we are going to take the current price. Remember, the current price is up here. So we can use the up arrow to move. So the current price is here, $2.71. So what we are going to do, we are going also to make sure that we put in some $signs here. So since we can't see down there, we can adjust from here. So we put in a $sign there, shift 4, then also shift 4. In other words, we are changing these values. All these values are going to be depending on that same number. So hit enter. Now, if you come to check to this point, Oh, sorry. It wasn't done. So we can adjust from here. Remember, we are just comparing, we are making a comparison. So what we are going to do, we less off 1 and then we hit enter. So I guess you can guess the last step. And the last step is actually to go into the cell K102, this very one here, and we make sure that we highlight and get these values, copy and paste special to have these values filled up here. So what we are going to do, we do a copy, Control C, hold down the Shift key, use the right arrow to highlight, down arrow to highlight downwards, and then we are going to Alt ES. So it is Alt ES, then we use the down arrow formulas, then we hit enter to have those values filled up. So you can see that we have all those values have been filled into those cells. So we've now done filling all these tables. But you have to look at these values that are within the center. You will see that these values, actually we got these values up. This was our view. This was the percentage of profit that we calculated last time. This was the equity value, and this was the enterprise value. So we've gotten all those values just by using those different sensitivity analysis without going through the other computations. So now we have actually got a couple of key takeaways from this discussion. Number one, using data tables is a really powerful tool in Excel, but you want to be a little bit careful. So what you want to go into is the other settings. We need to be careful, because if you find that your settings are actually not when they are not set to automatic, you may find that we may be having data tables failing to work. But at the same time, there are situations where the data tables are actually more than one. In other words, there are many data tables, and those data tables are actually in that same module. So what we do if that happens, we make sure that we set this automatic. So we can maybe try to go back a little bit. Alt F for file, then T for options, then we go down, use the down arrow to move down to formulas. This is what I'm talking about. It's supposed to be in the automatic. Secondly, if there are very many data tables within one financial model, you make sure that you select this option, automatic except for data tables. But again, if you do that, then you have to remember to hit that F9 key to manually update the data tables. The other thing that is so important to remember with data tables is that it can lead to a lot of errors. So the things that can actually lead to errors in here are these labelings here. These labelings, whether they are going to be on the x-axis and the y-axis, those labelings there, they are actually a problem. The y-axis, here we are seeing we have the work, the weighted average cost of capital. And the x-axis, we have the terminal growth rate. And we have to make sure that those can't actually move under any circumstance. So that what we have just done, keep things simple, and we have to make sure that even this value here is manually punched in. In other words, they are supposed to be manually inserted there. They are not supposed to be linked up. That value for 2% and this value of 13.5% for work. So that keeps our table centered on these values that you see, F92. Because if you have these values when they are hard codes, then we are going to have these values centered here, just like the way you are seeing here. But remember, this is the only table that we used as a data table. So we have that value F92 centered there of roughly 133,000. And this very figure here matches this value up here for this one. It's supposed to match this enterprise value that we have here of G81, the center value here, supposed to be matching this one. So those are the things that we need to make sure that we have. So we have to keep things really simple in a compact model. So this manual input here of 2.2% is really important. And even this manual input here, those are supposed to be manually input in that section there. So later on we are going to go over to the different sections and see how to build a self-centered data table. In other words, we are going to have the values for these ones, G80, for the work, and the values for terminal value there, G79. In other words, if we want to have self-centered figures here, the point here is that we have to make sure that those values of the work and the terminal value, if they ever change, then the enterprise value within here also has to change. Meaning, if these ones they change, this one, even this one will also change, and it will have a self-centered correct enterprise value for every single period or time. In other words, for every value that you are seeing in here in this table. So what we are going to do, let's go into the next video and we shall look at other things so that to conclude this chapter, because we are going to look at the things that we've discussed, and we'll look at certain things that we can actually add in and make sure that we have something that is going to have sense in our perspective. But as a way of concluding, this is a great work that we've done. We have completed the compact DCF model. As you can see, everything is now filled up. We are done. This is what we wanted to have in place. So we are done with those small models. And these small models, actually, they are so helpful for quick analysis, because you can almost think of these small models as screening tools in order to get into certain situations. In other words, to figure out some situations, because These are the things that are going to give you some insights about what can be in the full analysis. So these some sections that we've seen here, they are the ones that are going to give us a more understanding of what we shall expect to have in the full course. So now that we have gone through the transition for this DCF model. For the next step, we are going to look at the valuation techniques to understand where DCF fits in with those techniques. In other words, we want to look at some theoretical things. We look at the different things the different techniques that we use for doing business valuation, and we want to make sure to see how is DCF going to fit into those different methods that we have. And we are also going to talk about the importance of upfront model design, which can save us more of our time. So we are going to talk about also critical model drivers and why it is so important to isolate them on a different page. And this will allow us to run scenarios throughout the model to get an idea of how it reacts to these critical inputs. So let's try to move into the next video, and we are going to start on this more complex model as we keep on building our full DCF model. So let's go to the next video where we are going to look at the valuation techniques. We'll see you there. Hello viewers, welcome back. We hope you enjoyed building up the compact DCF model. We'll find those models so incredibly useful for getting a basic overview of how a DCF works. Also, they are really practical when performing quick analysis. So what we are going to do now is we are going through some theory that we are going to need to build up in order to put together a full complex DCF model. So let's get started and we see what we have. So basically today we are going to look at the valuation. We are going to look at the valuation techniques. And these techniques, they are the valuations that we use when valuing a business or valuing an asset. We are going to use them either when we are valuing an asset or when we are valuing a business. So some of those valuation techniques, as you can see them, those are the ones that, some of the ones that we have. But for this course, we are basically going to focus on three, but we are going to look at two for now. We are going to focus on what we call we are going to look at, what we are going to look at here is we are going to look at some valuation techniques. And in fact, the three most common valuation techniques. Now, the three most common valuation techniques that are used to value a company would be comparable trading analysis. Comparable trading analysis would be the comparable trading analysis. The second one is the precedent. This is the comparable trading analysis. The second one is the precedent transaction analysis. And then the third one is what we call the discounted cash flow techniques, or the DCF analysis. Although there are many other techniques, as you've seen in this video here, because here we have also the ones that are cost-based, cost to build, replacement cost. So there are others, but as we said, the mostly used forms, there are those three: the precedent transaction analysis, the comparable, and finally the DCF analysis. Now, although we have these many techniques that are used to value companies, these three are the most common ones that we use in valuing the company. Now, this course is obviously about the DCF analysis. In other words, we are going to put more of our emphasis on understanding the DCF, or the discounted cash flow analysis. But in order to understand the DCF analysis, we need to have a decent understanding of how it fits together with these other two techniques. Now, here is a common question that you may get as a person who is working in finance. If we were to use these three techniques in order to assess the value of the company, would these three techniques give you the same or similar values for the company? That would be the big question. Now, the correct answer to this question would be no. In other words, it's much more likely that these three techniques will point you towards three different values for the same company. We need to understand why we have these results. We need to understand why each of the valuation techniques can actually give you a different result. Because after all, we are trying to measure the same company, and we are just measuring it in three different ways, because the company is the same company or same business, but using 1, 2, and 3 approaches, or the techniques. But now the challenge is, why all these give different results? This one gives you different result from this. Even this gives you different results. Yet we are valuing the same business. That's what we are focusing on. Now, let's try to do some small demonstration. We demonstrate how we can basically explain this so that everyone can actually be able to understand it well. Now, let's try to bring in these small diagrams, these small shapes that you are seeing down here. Actually, let me just change the color for this. So, we have those three diagrams. Let's suppose that we are actually not measuring or we are not trying to measure the value of the company. Let's pretend that we are trying to measure the height of the desk. This is our desk inside. And what I want you to get from this point is that if you're trying to measure the weight, the height of the desk, and we have three different options or different techniques that we are going to use. We are going to use three different ways to do that. First of all, we are going to use the measuring ribbon, this one. We are going to use the measuring ribbon here. That's a ribbon. measuring ribbon. And in the second one, we are going to use the ruler. This is our ruler here. So we are going to use a ruler, and at the same time, or the third technique, we are going to use a tape measure, measuring tape, or a tape measure. But all in all, what we want to look at is the height of the desk. Now, the height of the desk, essentially, you will find that each valuation technique will give us some values there. In this example, the three different measuring techniques would essentially give us same results. Actually, from this point, all those three, they are going to give us same results. In other words, they are going to give us same height for the desk. So the question is, why is it when we measure the value of a company three different ways, we essentially get the different results? Essentially, why is it that each valuation technique will give us such different result? We need to explore this and understand it. So what we are going to do to try to understand this is that we are going to try to understand exactly why these techniques yield such different results. First of all, we need to make sure that we understand what the techniques are. We need to first know what are these techniques, what are the things behind these very techniques that we are using. So that's what we are going to first understand, because after understanding what they are, we can be able to understand why they are giving us different scenarios. Because from this perspective, from this example that we have, you may find that most of these we have their conversion. If this one is measuring in centimeters, this one may measure in meters. Then we do a conversion and we have the same thing. So we want to understand some of these items. Comparable trading analysis. So want to look at each of these items in the valuation perspective, in the views of the person who does the valuation. So comparable trading analysis. The first one, what it is and why it could actually give us a different result. Comparable trading analysis essentially looks at the valuation for similar peer companies that are publicly traded. There must be publicly traded peer companies. You may find that those peer companies are those companies that are going to be in the same range, maybe in the same line of production, in the same range in terms of the size. Now, for precedent transaction analysis, this precedent transaction analysis is similar in that it does a comparison to peer companies. But instead of looking at where they are trading, it's looking at the past acquisition prices for those companies. Past acquisition prices for those companies. In other words, you look at similar companies, maybe same size almost, in the same line of production, and you look at the acquisition prices. So this is where we build a model of a company that forecasts. Now we look at the last one. Last one is the discounted cash flow techniques, or the DCF analysis. Finally, for the DCF analysis is where we are going to build a model that forecasts all future free cash flows, future free cash flows. In other words, they forecast the future free cash flows, and at the same time, we discount those cash flows back to their present worth. In other words, we get the present value of all the future cash flows. So that's the implication, or that's what they basically mean in short term. So now that we have done a quick review of these three main techniques, let's start to investigate why they are different. First of all, comparable. Let me first move this. Now, for comparable trading analysis, this one right here is actually a relative valuation technique. It's a relative valuation technique. And this means that the value for the target company is really assessed relative to its peer and where they are publicly traded, or where they are trading in public markets. We look at the value, and it's supposed to be in relation to the peer and where they are trading in the public market or stock market. Now, similarly, even this one, the precedent transaction analysis, is also a relative valuation technique. And in this technique, the target company is valued relative to where the peers, in other words, they are relative to where the peers have been acquired in the past transactions. They look at the acquisition transactions or acquisition prices. And finally, for the DCF analysis, it is an absolute valuation technique. Sometimes it's referred to as intrinsic valuation technique. Intrinsic valuation technique. Intrinsic valuation technique. Essentially, we are looking at the target company, assessing its cash flows and discounting them back to a present value. And in this analysis, we don't consider the value of the peer. So it's not a relative valuation technique. So this explains partly why we get different results from these techniques, at least why we get different results from the DCF, because for it is an absolute valuation technique, and the other two, they are relative. But also, it really doesn't explain why we may get different results, because especially in these two scenarios, in these two methods, because if these two, between these two techniques, between the comparable trading analysis and the precedent transaction analysis, we would actually find a competing reason as why we are getting a different answer from those two perspectives. Yet these are actually relative valuation techniques. But we shall also try to look at some of the advantages and disadvantages. So in the next video, we are going to discuss a little further and understand more about the difference between these three techniques. So we are going to look at the advantages of this over the other one. We see if we can basically get the right answer to why we actually end up having some of these answers differently. So let's meet in the next videos and we'll look at the various views of our value. So we'll see you in the next video. Hello viewers, welcome back. We are now looking at various viewpoints of the value of the company. So let's dig in a little bit deeper to understand exactly why we get these differences when we pursue these three different valuation techniques. The key here is understanding that each of these techniques provides us with some insights into the views from different groups. What we can do for reference is just bring up the definition of these three techniques that we went over through already, just so we can refer to them in this discussion. We've seen these definitions. We've seen these definitions, these ones here. So we've seen those definitions in our previous video. Now, but we want to refer to those definitions into our discussion that we have for now. So let's start with the comparable trading analysis. Let's first remove these ones. Now, we want to start off with this comparable trading analysis. It is really the various participants in the market, the various market participants that are moving the stock prices, for these peer companies. So this technique is showing us some insights into the view of it shows some insights into their view, the market's view of the value. So we look at here as we are focusing at the market view, because it is actually the market participants. They are the ones who determine the stock prices for the different peer companies. So this makes it to be focusing on those participants' view or the market view of our value of the company. Now, if you look at the precedent transaction analysis, this one, the precedent transaction analysis, it is the previous buyers that agreed on, or they are the ones who actually set the acquisition prices. In other words, it's these previous buyers who said they agreed on whichever value they agreed on, and they set the acquisition price. So when we go through this technique, we are really looking into the buyer's view. We are looking into the buyer's view of the value of the business. And finally, when we look at the DCF analysis, it will be you, the person who is building the DCF model. It will be a finance analyst of the company, and you are the one who has done all the computations, meaning it is your view as a finance analyst, because you are the one who built the DCF, you are the one who built the DCF model, and you are the one who even selected the inputs, and you are also the one who selected the technique to use. So it is your view of the value of the company. So finally, we could just summarize and say, let's first delete this. we could summarize and say that comparable trading analysis is really showing us the market view. So it is only showing us the market view, and that market view of the value of the company. In other words, the people in the market, what they have decided in regard to the prices or the stock prices for the company. Then the precedent transaction analysis, that is showing the buyer's view of the value. And finally, the DCF analysis is showing us your view of the value. So the key to understanding this is just understanding that even though the underlying company is the same in all the three situations, these different groups may have different views of the value of the company. The market may have a different view than the previous buyers, and the buyers may have a different view than you who do those values for the DCF. So those values can differ depending on the viewpoints of these different groups. So let's move down and now think about some advantages and disadvantages to these three techniques. Now, let's start off with the comparable. The comparable trading analysis. Now, one big advantage is that it uses readily available data that is easily observable. In other words, it uses the data that is available. It is actually, the data is readily available, and it can be observable by any person. As long as you are within the market, you can access the market information. You can be able to get, even when you can't have access. If you were taken and you go into the field, you'll be able to understand that such and such a company, these different people, they are actually saying that the value is this, depending on what is prevailing at the moment. So that can be easily observable. And also, the pricing is efficient. The pricing is efficient. And in fact, it's updated for us constantly. But the big disadvantage is that no peer company or companies are exactly the same as the target company that we are trying to value. Because it is hard for, even if when these companies are in the same line of production, they are the same production processes, maybe they are on the same resources. The point is, they are not always going to be the same, because you may find that these companies actually having strong internal control system in terms of maybe the people they employ. So those are some of the things that that are non-quantifiable, but you can't equate them anyhow. So it is hard to find those peer groups that are actually the same as the very company that we are trying to value. So that's the disadvantage. So now we are done with that. If you consider this precedent transaction analysis, the first advantage is very similar to comparable trading analysis. The data is readily available and easily observable. It also shows us the market for a possible sale of a company or possible purchase of the company. Because here, the information, yes, is available, and even it shows us the sale, how much we can make if we were to sell the company now. We can readily get that information. So the challenge is that, or the big disadvantage is that it is hard to find a perfectly comparable peer. But also, it can be difficult to find recent transactions. Even recent transactions, they may not be there. Because for you may be having the information, yes, it is readily available, but maybe the company was bought early 90s, and you are still using the values of early 90s because they are the ones that you have. That's when you bought the company. So the recent transactions, they may not be available since we are looking at previous buyers. Finally, let's take a look at the discounted cash flow techniques, because that's our best method. Finally, as we look at the discounted cash flow techniques or the DCF analysis, it is a very sound found valuation technique. It provides us with a wider and wonderful opportunity to learn so much about the underlying business. We get opportunity to learn because you go through all the future cash flows the company anticipates to generate from the projects they are undertaking. You get to know what the company does. You get to find out some of the challenges, because by looking at the cash flows, they are outflows and inflows. It means it's like you are taking the whole business. You have to be, by knowing the outflows and inflows, you have to be doing good bookkeeping to have everything in place. So it gives us an opportunity to learn about the business. But now the challenge is that the big one is that it requires a lot of inputs. Now, if you find companies that don't actually keep their records, it may be hard for you to actually start penetrating into those transactions. So it requires a lot of inputs. And remember, the model that you are building is as good as the inputs that you are using. So if you get wrong inputs, it means you are going to get wrong results and you make wrong conclusions. So we need to be very careful and make sure that we are comfortable with the inputs that we are going to use, and they can make economic sense, not just picking figures that don't actually add up to anything. You can't reason them out. So it's great that we have been able to go through the overview of these three really common valuation techniques, and we are now know how the DCF analysis or the DCF technique fits in and how it compares to the other two techniques that we commonly use. What we are going to do now is focus on the DCF analysis, and that focus is going to start in the next video as we take a look at how to design the DCF model and what they are going to be used for. So we are going to look at the DCF model design, and this is going to be the whole, in other words, the full DCF. That's what we are going to look at in the next video. Thank you for watching. Endeavor to subscribe to our channel. You hit the notification bell icon to make sure that you get notified whenever we upload new videos. There are so many things that are coming in. Stay tuned. Bye for now.